stocks are going to continue to go higher.
Do you want to be in this market? Do you want to be riding this? Yes.
This is still a market with a lot of cash on the sideline.
We're doing our best to enjoy the sort of nirvana that markets are benefiting.
There is a lot of optimism built into the market, which does create vulnerability.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, looking for a boost from Beijing. The US reportedly clearing some Nvidia chip sales to 10 firms in China as AI chip maker Cerebras is gearing up for the biggest IPO of the year. Cisco is knocking it out of the park, delivering a better-than-expected forecast. Cisco surging in the pre-market.
I feel like right now AI is the equivalent of blockchain. A number of years ago when Overstock came out and said that they were going to be really now a blockchain company, not a furniture company, and their stocks just absolutely surged. Cisco came out, and yes, they did deliver solid earnings, but they said that they booked $9 billion of orders versus the previous $5 billion expected for the full year, coming from AI hyperscalers. This idea that they are providing the systems, the networks, for some of the hyperscalers, that alone is giving a massive boost to a name that is reminiscent and has the history in the dot-com boom.
You want to talk about the vibes? All the vibes in 99, Cisco crushing it.
Correct.
Big IPO coming up a little bit later. Had a marketed range, blasted through that marketed range and looking for a big move later this morning.
Yes, Cerebras initially was being marketed around $140 to $150 a share, came out at $185 a share. The market capitalization is something closer to $40 to $49 billion, depending on how you account for this. I keep going back to the idea of a unicorn being $1 billion. If something comes in as $1 billion, that's a discount. It's a joke. It's essentially a penny stock. This just gives you a sense of how much our benchmark has changed.
Let's talk about Nvidia, a multi-trillion-dollar company in the pre-market, up by a few percentage points. This from Reuters this morning, reporting that the US has cleared Nvidia to sell the H200 chips to 10 Chinese firms. What we don't know is whether China will let them in. So this is only one half of the story. And given they're in China right now, let's see if we get the other 50% of the story a little bit later this week.
There is this issue of what has actually changed, because supposedly these chips were for sale, then China wasn't buying, then maybe they weren't for sale and were blocked. The idea that every time the story comes back, Nvidia notches another 2-3% gain gives you a sense of people's sentiment right now. Nonetheless, there is an expectation that something will come out of this, that tech will come to the forefront, that potentially there is an easing in tensions around the oil picture, at least rhetorically. The big question mark is still Taiwan, and that actually really is people's concern.
Nvidia up in a pre-market by 2%. Annmarie on the ground in Beijing. We'll catch up with Annmarie a little bit later. For President Xi, this stood out for me. The doors to China for the outside world will only open wider. That felt to me like the issue of 10 years ago, 15 years ago. The issue of today is whether others will open the door to China. That's how things have changed in the last few years, the pushback from everybody else.
Because they've been cannibalizing the industries from Europe, from the United States, and people are saying that your policy of oversupply just isn't going to work for us based on lowering prices and putting people out of jobs domestically. What's interesting this time around is that the Chinese renminbi is on the longest winning streak versus the dollar going back to 2017.
Strength.
We've seen a real strengthening. When you take a look at the strongest versus the dollar since 2023, this isn't just lip service. This seems to be on a financial level as well. That is sending a signal that they want to be a world leader, that they want to be more of a reserve currency. That's sending bigger signals than some of the rhetoric ones.
Should we talk about the bond market?
I would love to.
And a signal from fixed income, 2s, 10s, 30s. Let's look at the long end of the curve, 30s. This morning, 5%. And something interesting happened at a 30-year auction yesterday that hasn't happened for almost 20 years. If you bought into that auction, you got a 5 handle, a 5% coupon.
Which is the first time you've seen that level being sold on a 30-year bond going back to 2007. This highlights the fact that people are looking at a new regime. It also highlights the fact that it isn't enough to really bring people in a rip-roaring way, because it wasn't a rip-roaring auction. It was tepid. Sort of the envy. I'm sure the U.S. government has a lot of envy for the likes of Alphabet that seems to be selling debt anywhere and anyhow with very low rates. Torsten Slok put out a note this morning. I thought it was interesting. Higher for longer continues. He said the parallels with the energy shocks of the 1970s are worrying. The last mile of fighting inflation is a marathon rather than a sprint, saying that given this and ongoing fiscal challenges, it seems like yields are going to be higher for longer.
Best of luck, Kevin Warsh. More on the incoming Fed chair a little bit later in the programme. Yields this morning on 30s, just about unchanged at 5.03%. Coming up this hour, we'll catch up with Julian and Emanuel of Evercore as big tech looks to extend a record rally. Ferragu of New Street Research as top US CEOs chase deals in China. And Eric Nelson of Wells Fargo as markets brace for a Warsh-led Fed. We begin this hour with stocks adding to all-time highs. Julian and Emanuel of Evercore writing, it is very clear that the investing public's love affair with tech stocks is in full bloom, driven by exceptional earnings and reasonable valuations. Julian joins us now for more. Julian, good morning.
Good morning.
Let's talk about the 99 vibes. The 99 vibes are one thing, but when you write that last line there about valuations and earnings, how different is this moment to then?
Well, that's the biggest contrast, okay? Because back then, everything was a much more speculative in terms of the valuations. And look, if we go back to the benchmark of the last 3 years, stocks are higher valuation-wise. But the thing about the last number of months, particularly in the NASDAQ, is the earnings strength has been so intense that valuations have actually started catching up to earnings. And so for us, what's really happened, and also in consideration of the fact at the end of last year, there was a decided dislike of technology, which really pivoted at the March 30th low. But in a lot of ways, tech has become value.
There was the itch to rotate, and now the big complaint is the breadth is bad. The breadth is terrible. Can you see a picture ahead of you where this resolves bullishly?
Well, look, so, and the contra to that was, if you go back to the beginning of the year, there was a belief that the halo trade would be enough to take the indices higher without tech participating. That was debunked. The math tells you that at 55%, tech and AI exposure in the index, you need that. And so there certainly is a case for medium-term bullishness. But again, like everything else, this too shall pass. We just don't think you're anywhere near that time yet.
To build on what John is talking about, do you need to start seeing the return on investment in a material way in the non-tech names in order to keep this going? You have to see some sort of revenue prospect from this in order for people to keep buying at these levels, no?
You do, but again, going back to even if you separate the issue of AI from the rest of corporate America, margin management continues to be incredibly robust. Sales volume is incredibly robust. And it's not just inflation. It's real, true demand. And yes, you can sort of tie it all back to AI, but we've had other periods in time where technology has been a driver of the economy. And again, it doesn't always end badly.
Margin management, nice way of saying they're still raking in the cash. They're still able to pass along those price increases to consumers, which is a huge problem. We see what PPI did yesterday and what CPI did the day before. At what point do you have to start getting really concerned about inflation remaining in kind of 1970s-like patterns, which is what Torsten Slok was pointing to this morning?
Right. Well, I think we have to acknowledge something here, okay, is that we do still have an inflation problem. And from our point of view, whether it's the price of hamburger or $4.50 or $5 a gallon, or the fact is that when you think about the degree of the price spike in energy that we've had and the time of this spike, we find that there's a danger zone to where, if we're talking about triple-digit oil on the 4th of July, instead of looking at the fireworks display, we are likely going to run into headwinds.
I was surprised yesterday. PPI came in much hotter than expected, following a much hotter than expected, or rather marginally hotter than expected CPI reading earlier this week, and yet yields dropped at the front end of the curve by a single basis point, not a big deal. The resistance you are seeing at certain levels in the bond market, I think, is somewhat notable, given the data we saw just yesterday.
People are looking for silver linings, and they found one in that the components going into core PCE actually brought that level down because of some of the portfolio management costs and a couple other metrics that do feed into that key inflation reading. Nonetheless, we do have an inflation problem. Even Susan Collins is talking about that. Fool me once, shame on you. Fool me twice, shame on me. That is what they're saying. So why are we not pricing in a greater chance of a hike?
Because this Fed doesn't want to hike. I think that's it right now, that ultimately this Fed really doesn't want to hike interest rates.
Not happening. Fed is not hiking this year.
So that's the 2-year dealt with, if you really believe that. What about further out along the curve, where maybe there's a bit more flexibility to price in some action?
Well, but again, that supports the idea of a yield curve steepening, and we have to face it, and it's certainly has not been a bad thing these past 6 years, except for short bursts of time. But we have started a new multi-year regime where yields on the long end are going higher, and they're going to continue.
Does that present a challenge to equities or not?
In the long term, it by definition it has to. But again, the earnings strength has been so profound that in our mind, we think that you're going to be okay until the 10-year yield starts nudging towards 5.
Could you ever see Magnificent Seven or just the tech sector in general with spreads trading inside of government spreads as they borrow so much money to fuel some of their spending plans?
Well, I think back to a number of years ago when I believe it was Austria issued the 100-year bond at 1%. You can't disbelieve that anything could happen in this environment.
The reason why I ask this is because we say that eventually it will be a constraint. If you get to maybe 5.5% on the 10-year yield. At the same time, we're at pretty elevated levels, and you still see different companies issuing record amounts of debt and going around the world to do so. At what point does this stymie capex plans in a more material way?
Well, what's fascinating about that, Lisa, is, again, remember, think of it as some of these hyperscalers issuing in Europe to insatiable demand, because you've got the exposure to the hyperscalers that you want, and you have it in your home currency. And frankly, part of the narrative of the last year plus has been that, in our view, you made a long-term top in the dollar, and if you don't have to worry about FX exposure, that's a bigger plus.
It's the crowding out that starts to get interesting. Just going through the numbers, there's a fantastic write-up on the Bloomberg terminal about the sheer scale of the numbers that are being issued from some of these hyperscalers. On Alphabet specifically, close to $60 billion. And the team here at Bloomberg writes that's quadruple the amount of bonds Alphabet had sold in its first 26 years of business. This is a very, very different phase for these companies.
Yeah, and they're going around the world because they're trying to diversify away from the United States before the United States starts pushing back. Nobody wants a sale to go badly, so they're going around the world, picking the coins out of the couch cushions, as some people have said, and they're trying to figure out how to create a robust market in some of these places that really want hyperscale.
Julian, not all the big spenders are doing well in this equity market. Alphabet feels like a bit of an exception right now. Microsoft, Meta, Oracle have traded softer throughout the whole of this year to date, down on the year. They're the big spenders supporting the revenues and profits of the big chip makers who are absolutely surging. How are we going to resolve that tension?
Well, so there's been this residual fear is if your business model is associated with software in some way, shape, or form on the one hand. And frankly, actually, we're happier that that fear hasn't been completely cast away, because it's the casting away of fear in its entirety that will end up being the market's biggest problem at some point, when FOMO kicks in its entirety. And then, of course, there is the market picking and choosing amongst the hyperscalers that they're most preoccupied about the free cash flow profile. And look, it has edged down materially in the last several months, but it doesn't stop our semis analysts from predicting $1 trillion in AI-related capex next year.
Looking for more of the same.
Yeah.
Even more. Julian, it's good to see you. You've got to stick with us. Julian Emanuel there of Evercore. Equity futures on the S&P near session highs, up by 0.25% on the S&P 500, with an update on stories worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, good morning. President Trump and Xi Jinping discussing a series of issues in Beijing on Thursday. Speaking for over 2 hours, Trump and Xi addressed expanding U.S. access to China markets and China purchasing more U.S. energy and agriculture. Xi did warn Trump of a potential conflict if the Taiwan issue is mismanaged. A UK naval group says a commercial vessel off the coast of the UAE was taken by unauthorized personnel and is heading for Iranian waters. The ship was taken while it was anchored. Its country of origin was not immediately clear. The U.S. Senate confirming Kevin Warsh as chair of the Federal Reserve in a 54-45 vote, the narrowest margin on record. Warsh says he will keep policy free from political influence when he takes over from Jerome Powell, whose term ends on Friday. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for the update. More from Vonnie later this hour. Up next on the programme, diplomacy on display.
It's an honor to be your friend, and the relationship between China and the USA is going to be better than ever before.
We're not trying to constrain China, but their rise cannot come at our expense. Their rise cannot come at our fall.
Up next, we'll catch up with Annmarie, live from Beijing, live from New York City this morning. Good morning. I count 6 XPX price target upgrades since the war started. Morgan Stanley, Mike Wilson, the latest 8K year end, 12 months. The 12-month price target over at Morgan Stanley now 8,300 on strong earnings. Now, we can compare this moment to 99. I get it, all the vibes, but the earnings have been absolutely phenomenal, and that's what the price target hikes are based on.
You know, one thing that Julian and Emanuel referenced is something a lot of people are referencing, which is that we saw a valuation reset when big tech was falling behind some of the other index. Remember the whole broadening out, and can we get another high without tech participating? That came along with growth in earnings. So all of a sudden people are saying we need to catch up to that, the falling behind that we saw at the end of last year.
All-time highs coming into Thursday, adding to them this Thursday morning, up 0.25% on the S&P 500, on the Nasdaq up by 0.25. Under surveillance this morning, diplomacy on display.
It's an honor to be your friend, and the relationship between China and the USA is going to be better than ever before. Whenever we had a problem, we worked that out very quickly. We're going to have a fantastic future together.
We're not trying to constrain China, but their rise cannot come at our expense. Their rise cannot come at our fall. They have a plan. When that plan is in conflict with the national interest of the United States, we need to do what's right for the United States.
So here's the latest this morning. President Donald Trump in China touting his relationship with Xi Jinping. The two leaders wrapping up a bilateral meeting focused on trade and the war in Iran. Anne-Marie's in Beijing for more. Hey, Anne-Marie.
Hey, Jonathan, the two leaders are back again at the Great Hall of the People, where I was with them earlier this morning when President Xi really had this warm welcome to President Trump, his cabinet, as well as a host of the executives. About $20 trillion of market capitalization was standing on the Great Hall of the People steps, welcoming both of these leaders. And they are back there right now for a banquet, surrounded by American, Chinese executives. Xi Jinping giving a toast, welcoming President Trump to China. And it comes after we've had slightly different readouts when it comes to the White House and when it comes to China. The White House didn't mention Taiwan once. Clearly, they want to focus on some of the wins here when it comes to agricultural purchases, discussing maybe more energy purchases for China to buy U.S. goods. And then when it comes to the Chinese readout, while the two leaders were sitting in a bilateral meeting for more than 2.5 hours about, China state TV and state media was already pushing a readout that talked about how these two nations, she wanted to say to the United States, these two nations need to deal carefully with the question of Taiwan, or potentially it could become a dangerous conflict for their bilateral relationship.
Anne-Marie, at risk of making too much of this moment, in your experience, how unusual is something like that?
This feels incredibly unusual, even just this state banquet, especially given the fact that we spent an entire year having this tit-for-tat trade war between Washington and Beijing. This is a president that, remember, had a rise in the United States because he was a China hawk and called out China for some of their unfair trade practices, their subsidies of Chinese companies, how they make it difficult for market access for American companies into the United States, which is interesting why you also really caught that line from Xi Jinping talking about how he wants to open up China. Well, that is a tale as old as time. We've heard from Chinese officials on the global stage, especially speaking to corporate America. I think for executives sitting in that room, you have Elon Musk, Jensen Huang, Dina Powell of Meta is there. You have David Solomon of Goldman Sachs, Jane Fraser of Citi. I think they would want to see more details and proof in the pudding when it comes to some of these words.
Anne-Marie, can we just finish on Nvidia? I'm sure you saw the reporting that came from Reuters overnight, indicating the US had cleared Nvidia to sell H200 chips to 10 Chinese firms. What isn't clear to us at the moment is whether China will actually allow those firms to buy those chips. What do you know?
Well, Reuters is reporting that the U.S. has signaled they're going to allow the sale of those H-200s. Remember, the H-200s were banned, and then there was a reversal in January, and they were allowed to be sold into China, but the United States would get a cutback, really a kickback of 25%. Okay, so Alibaba, Tencent, according to this report, can buy these chips. That was never the problem. The issue was China was not allowing these firms to purchase the H-200s. That is still a key question. They are going to have another day of bilateral talks. We know that Jensen Huang is here. Potentially, we're going to get some clarity.
Annmarie, looking forward to catching up with you later in the programme. AMH over in Beijing, as we're having this conversation, some headlines just crossing from Xi Jinping directly.
Yeah, saying that China-U.S. ties have been stable with via talks with Trump, and then going on to say China-U.S. relations can only be improved, not worsened, giving a sense of where we're coming from. I will just say, though, this is probably the harshest rhetoric we've heard from China regarding Taiwan in a very long time, if ever, and talking about how this is the most important issue to China and that if red lines are crossed, it could become a very dangerous situation, is something that definitely was notably omitted from the U.S. readout.
I smiled when I read that headline as well, that they can only get better from here.
I imagine that's...
The bar has been pretty low. Let's put it that way. Julian Emanuel of Evercore with us around the table. Julian, let's continue this conversation with regards to China. Is this a market issue anymore? Does it matter whether Nvidia gets access or not?
It certainly is a market issue, okay? It will continue to be a market issue, but it's sort of, you know, the drama plays out over longer time frames and in different nuances. But again, the subtext, it's not just chips, it's oil, okay? And we haven't heard any discussion of what may or may not happen around Iran. And obviously, the ideas are different. You know, there's more of an immediacy on the part of the U.S. to unblock the strait. And China clearly has patience, given that its stockpile of oil appears to be larger. But they are both incentivized, you know, in the medium term at least, to get this unblocked. And you can't disaggregate chips and technology from oil. It's part of the entire dance.
You noted tech for oil seems to be your takeaway from these meetings. Do you think that there's going to be some sort of trade from the U.S. giving certain access to technology in return for either China releasing some of its oil reserves or potentially intervening in Iran?
Well, we may not actually ever know that, but to think that something like that isn't being discussed is likely naive. And think about the other aspect. Again, we have two readouts of the first session that are radically different. So what really happens and what really is going to happen is an open question. And in our mind, the most important thing to look out for is how does the oil price respond next week? Because if the oil price doesn't start heading lower, that's when there are going to be, you know, thoughts around whether the tension has in fact eased because of these 2 days.
The Chinese leader just wrapping up these comments at this banquet in Beijing. We'll carry on tracking the headlines coming out of China. Just want to finish on this market with you. You've seen a lot in your career. I'm not aging you, just highlighting your experience. All-time highs on the S&P, record highs on the Nasdaq 100. Lisa and I were talking about regret minimization earlier this week. You remember back in .com that if you missed it, your career was under pressure. Being early wasn't good. In this moment right now, do you sense the same forces shaping some of the approaches to this market at the moment?
There's no question about it, but you have to understand and think about this. This has been a consistent theme since 1982, okay, when the secular bull market of several generations began, is that investors by nature are optimists. You can't invest without being optimists. So if that's the psychology, which it is, then, you know, you are going to be penalized for missing the upside disproportionately to the regret of you know, escaping the downside.
Julian, it's good to see you, sir. Thank you. Julian Emanuel there of Evercore. Coming up on the programme, Pierre Ferragu of New Street Research as US CEOs look to expand business in Beijing. In Beijing, the President of the United States speaking right now at a banquet in Beijing. We'll take those comments and bring you some headlines throughout this morning. The president speaking in Beijing, China, at a banquet alongside the Chinese leader Xi Jinping. Let's listen in.
华盛顿总统，目前这个石碑已经镶嵌在华盛顿纪念碑里面。石碑上刻有当时的一名中国官员形容这一名伟大的将军和政治家，他们把他称为人中豪杰。
And across the centuries, this mutual esteem grew into a relationship that reflected the tremendous talent and potential of our two people. Chinese workers helped lay the railroad tracks that connected our Atlantic coast to the Pacific. American travelers to China helped spread literacy and modern medicine. And at the request of China's ambassador, it was President Theodore Roosevelt who provided the funds to establish President Xi's alma mater, Tsinghua University.
在过去几百年当中，这种相互的尊敬已经成为了一段全新的关系。这段关系可以说反映出我们两国人民之间巨大的潜力以及我们的努力和智慧。中国工人当初帮助美国建设了我们的铁路路轨，连通了美国的大西岸和太平洋沿海地区。美国当时早期出访中国的美国人也帮助中国提升了识字率，并且引入了现代医学，并且应时任中国驻华大使的请求，罗斯福总统也专门提供了资金，成立了习主席的母校清华大学。
As allies in World War II, President Franklin Roosevelt's mentions of the brave people of China, that's what they were, drew loud cheers in his speeches in the United States, and everybody loved what he had to say, just as many Chinese now love basketball and blue jeans. Chinese restaurants in America today outnumber the 5 largest fast food chains in the United States, all combined. That's a pretty big statement.
The President of the United States with some comments in Beijing, China, at a banquet alongside the Chinese leader Xi Jinping. We'll get some headlines for you and we'll share them as they come through on the Bloomberg terminal. Equity futures right now, the S&P is the price action. All-time highs, adding some weight to that rally, up by 0.25% on the S&P, and the Nasdaq up by 0.2. Plenty of fireworks to talk about in the bond market. The 2-year pinned around 4%. The 30-year gets more and more interesting, north of 5%. A fixed rate of 5% at a 30-year auction yesterday for the first time in almost 20 years. At the same time, we had hot CPI, hot PPI, and a new Fed chair.
This is a market that does not believe that this Federal Reserve will raise rates anytime soon. Even though it's starting to be priced in on the margins, the indication here in the steepening of the yield curve is that inflation will be a bit stickier for longer. You can see that in the break-even rates as well. The idea that 30-year bonds were sold at a 5-year handle, 5% handle for the first time going back to 2007 gives you a sense of how much things have shifted. It also gives you a sense that even that wasn't enough to bring some sort of blockbuster demand. And that, I think, is pretty telling about people's concern longer term.
Middling demand, it's fair to say. Not that impressive, even with a coupon of yield like that. Equity futures then, just about positive. Let's get you some single names, some morning movers. There's some big ones out there. Yahara has more. Hey, Yahara.
Exactly, John. And we start with that big one. We are seeing shares of Cisco soaring more than 16%, set for its biggest post-earnings jump since 2002. That's because the largest maker of networking equipment posted a beat and a raise and announced it is cutting thousands of jobs to focus on AI. Plus, it raised its forecast when it comes to AI orders from hyperscalers from $5 billion to $9 billion in the next fiscal year. Turning to Nvidia, another strong day for that company, up 1.7% as we get a flurry of headlines out of Beijing. First, you have President Xi telling U.S. business leaders, including Jensen Huang, that China will open its doors wider to foreign companies, though those companies have heard that before and the barriers still stand. And then you have that Reuters report saying that the U.S. has approved several Chinese tech giants to buy the Nvidia H200 AI chip, though it's unclear, as Annmarie was saying earlier, whether China has signed off on that. And we end on shares of StubHub. They are soaring more than 15% in the pre-market after it reiterated its full-year outlook, pointing to a packed live event schedule and strong demand for everything from concerts to sporting events. And StubHub sounding especially bullish on the World Cup, saying that it expects to capture an outside share of those ticket sales. John.
Yahara, thank you. More from Yahara in the next hour. On our radar this morning, the President of the United States and Xi Jinping striking an optimistic tone at their summit in Beijing. Trump saying the US-China relationship will be better than ever before. Xi saying the countries should be partners and not rivals. The President speaking just moments ago, inviting Xi to the White House on September 24th. Elsewhere, the Senate confirming Kevin Warsh as the next chair of the Federal Reserve by the slimmest of margins that we have seen in years, a 54 to 45 vote. Warsh taking the helm after Jay Powell's term expires tomorrow. And finally, pressure mounting for UK Prime Minister Keir Starmer to resign. Rivals within the Labour Party preparing bids to challenge his leadership. The party seeing disastrous results in local elections and Starmer facing historically low approval ratings.
Yeah, unclear exactly who could actually get ahead, though, because there have already been a number of people who've taken out of the running. Wes Streeting, who you were talking about yesterday, is planning to quit the cabinet. This is widely expected. Still, there are questions about his ability to really be in the running. And then his former number two, I love how all the people around him seem to be just completely undermining him and ready to run against him. Is this sort of the, is this the norm in Britain?
It's becoming the norm, isn't it?
I mean, it's sort of who's going to stab you in the back first.
I hear people describe this as stability with the current government or chaos with something new. I would offer a different kind of way of viewing things. Slow decay with the current government or quick decay with something new. There needs to be a complete change in policy in the UK.
Well, I think that bond markets would agree with you. Some people might say that's incredibly harsh. Other people are saying, well, just take a look at the 10-year gilt yield. And you can see this concern that the bond vigilantes have that whoever comes into power is not going to have the answer to the fiscal situation. And even if Keir Starmer is going to preserve his role, yes, that might give marginal stability, but that still leaves yields very much the levels during the Liz Truss moment.
I heard one member of the Labour Party in the last 24 hours talk about the debt and how they shouldn't be governed by the bond market. If you don't want to be governed by the bond market, don't borrow so much money. That is true of governments, it's true of people too. If you don't want to be governed by the bank, don't take out a massive mortgage. Why is it any different for governments? Why don't they see it like that? It's not about being governed by the bond market like it's this boogeyman we just succumbed to. It's the fact that over successive governments you've borrowed so much money, decade after decade, that you are now basically outsourcing policy to fixed income markets.
You could argue that, and markets do not give out runner-up prizes. They don't give a prize to everybody. They pick winners and losers, and ultimately that is going to be a problem that every developed market is going to have to deal with, and increasingly you're seeing that being priced into the yields.
That's the UK. It's messy. In the equity market right now, record highs stateside. Top US tech CEOs in Beijing pushing for the world's largest economies to strike new deals.
They're here today to pay respects to you and to China, and they look forward to trade and doing business, and it's going to be totally reciprocal on our behalf. So I really look very much forward to our discussions.
Reuters reporting this morning the US has approved 10 Chinese companies to buy Nvidia's second most powerful chip. To discuss, Pierre Ferragu of New Street Research joins us now for more. Pierre, good to see you in person. Good morning.
Hi, John.
Let's talk about Nvidia. Do they need access to this market or not?
Well, very near term, they probably don't need it because they just can't manufacture enough chips to meet the demand they're facing at the moment. Now, the concern of Jensen is far more strategic. In the long run, it's very dangerous for Nvidia to let alternative ecosystems flourish and do well. So the more Nvidia can actually sell chips into the Chinese market, the less it gives room in the Chinese market for an alternative ecosystem and chip maker to emerge and flourish, basically.
Have you seen anybody actually start to emerge and flourish in the Chinese market to actually compete directly with Nvidia?
Well, for the moment, it's nothing really serious. You've probably heard about DeepSeek, who've made the headline a bit more than a year ago, training a model on Nvidia chips and then complaining about the difficulty of keeping innovating without the Nvidia chips. So for Huawei and others, manufacturing chips in China is very challenging. The Chinese don't have access to the most leading edge technology, and their ecosystem is late, like the decades of investment in CUDA, in all the software that goes into an Nvidia chip, of course, is something very difficult to catch up with. And the idea from here is, do you want to slow China, letting them access the Nvidia chip? So it's slowing China in developing their own ecosystem, but it's of course accelerating China's ability to do well in AI. Or do you want to do the opposite, which is to cut them off from the best chips available around, the Nvidia chips? And in that case, it slows them down in AI, but it's favoring the emergence of an alternative ecosystem.
The divergence between national security officials in Washington, D.C., who are freaking out at the idea of H200 chips being sold into China, and the markets that are getting very excited about that, because that will just broaden the investment base for this, gives a sense of the division, frankly, on a broader level between people who say this is an existential threat, an existential moment for countries to invest in big tech, versus those who say it might be overhyped. Hold the brakes. There's a lot of risk developing here. Maybe we should hold it back. Do you think that the innovation that you've seen over the past couple of years justifies this feeling of existential risk and endless investment being a good thing?
Yes, so definitely. I don't know how much you're using AI, but like the pace of innovation is mind-blowing. The potential use cases, you're still looking at what you thought AI was 6 months ago, and you look at what AI is doing today, and then you hear about these new models that are so good that they can't even be released. There is something that is existential about AI, and there is something also that is extremely lucrative, and that's the reason why nobody needs to ask all these players to invest like trillions of dollars now in AI data center and running out of place to deploy them and talking already to send them to space. So that's the situation in which we are today, and that's a race. And that's probably the core of the meetings in China today.
People often compare the unveiling of ChatGPT to the unveiling of Netscape back in the mid-90s. With that in mind, where do you think we are compared to the 90s? What year is this? Can you pick a year right now?
From which perspective, John? Like
from the perspective of market performance and stock prices specifically.
Stock prices. The great difference between today and the 90s is actually valuation. Like these companies are extremely profitable. That's difference number one. And then difference number two is actually how the pace of innovation translates into growth. In the 90s, I can't remember like a Netscape or anyone else adding a couple of $1 billion of recurring revenues every week. And this is the situation in which we are today.
It's an amazing situation that we're in. It took us a while to find out the winners. And it took a while because we had to go through the bus first. Do you think that the sequencing is different this time around?
No, actually, that's very interesting. I find a lot of similarities. Like picking the winners in the AI race today is a dangerous game. I wouldn't venture too much into it. What's interesting is that I think you already have quite a lot of evidences that it's not going to be a winner-take-all game. So there's going to be multiple winners. You see it, and I think like the geopolitical and strategic aspect of it is very important. Like sovereign countries will want diversity, and even you see it in use cases where players start, specializing on specific areas of the application of artificial intelligence. But market shares are going to move back and forth very, very rapidly. It's going to be about innovation. It's going to be about cracking the new use cases, like the first to figure out software development agents is now taking over everybody else. We see that now. And it's going to be about compute. Because what's the primary driver of market share in AI today is compute. And so you understand the tension between the US and China from that perspective. If you want to be ahead of the curve in AI, you actually need to deploy the most cost-efficient data centers the fastest you can.
Do you think, though, that some of these AI names will move from being treated as growth or value stocks to utilities, where essentially they need to be incredibly regulated, they're incredibly asset-heavy, and they have to deal with different technology cycles that they have to finance every 3 to 5 years?
So if you talk about like the frontier labs, yes, for the moment, the frontier labs are actually facing so much like capital needs that you see that most of them actually are not even investing in the data centers themselves. They need the balance sheet of the hyperscalers, of the neoclouds to do the investment for them. So they are growing like their cost commitments. They will need to continue to spend gigantic amount of money on compute, and it is a very competitive market. So where they emerge, we'll have to see. Now, keep in mind that this is going to be a very oligopolistic market. You don't see more than a handful of players really being able to invest at that scale or convince their ecosystem to invest at that scale. And that's just the beginning. think about where you're going to deploy the next data centers. If we need to deploy 10 times more data centers than we do today in 10 years from now, this is going to be in space, right? And you see that going to go to space, you don't have that many players able to launch very large satellites in space. And so that competitive game is going to remain like very oligopolistic. And so I'm not too worried about their ability to make money from that, for that reason in the long run.
Pierre, you've given us a lot to think about. Pierre Ferragu there of New Street Research. Good to see you, sir. Thanks for being here. Equity futures positive by 0.2% with an update on stories worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. President Trump and Xi Jinping wrapping up comments at a state banquet in Beijing. Trump praising their, quote, extremely positive and productive conversations, emphasizing his long-standing personal relationship with the Chinese leader. Trump extending an invite for Xi to visit the White House in September. Cerebras Systems raising more than $5.5 billion in its IPO, making it this year's biggest offering so far. The AI chipmaker pricing its shares at $185 each, giving it a market value of about $40 billion. Shares will begin trading on the Nasdaq today. Secretary of State Marco Rubio says the U.S. will push China to take a more active role in ending the Iran war. Rubio also highlighting the importance of striking a balance in foreign policy with China, calling Beijing a top political challenge. And that's your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in the next hour. Up next on the programme, shifting leadership at the Federal Reserve.
The chair of the Federal Reserve has a lot of influence, but when it comes down to a vote, the chair is one of 12 voters. And so a new chair coming in will have to persuade his or her colleagues that this is the best course of action.
Welcome, Kevin Warsh. Eric Nelson of Wells Fargo joins us next, live from New York City. You're watching Bloomberg TV. Record highs in yesterday's session, record highs this morning, and it's some weight to the rally, up by 0.2% on the S&P. Likewise on the Nasdaq, some decent news out there. For the tech stock trade, Cisco absolutely crushing it. We've got an IPO coming to market later, Cerebras, way above the marketed range. They're the 99 type vibes, but as many guests have already pointed out this morning, that's where they end. Valuations, earnings, pretty powerful stuff.
The earnings are actually outpacing the valuation gains, and that's the reason why people say, yes, Cisco might be the poster child of 2000, but it is not the poster child of 2026, at least not in a bad way, in a good way, because now they're booking revenue from hyperscalers, and this shows that they're able to recreate themselves in the guise of a modern company, and that is what people are pointing to. Not a lot of fear out there, frankly.
That's the stock market. Let's turn to fixed income, where maybe a bit of fear is brewing. Just a little bit. 5% on 30s at the front end of the curve, around 4%. Hot CPI, hot PPI. Under surveillance this morning, shifting leadership at the Federal Reserve.
The chair of the Federal Reserve has a lot of influence. The chair sets the agenda. What are the topics we're going to talk about? But when it comes down to a vote, the chair is one of 12 voters. And so a new chair coming in, whoever the chair is, whatever the environment is, will have to persuade his or her colleagues that this is the best course of action.
So here's the latest this morning. The Senate confirming Kevin Warsh as Federal Reserve Chair in the slimmest vote ever for a head of the central bank. Eric Nelson of Wells Fargo writing he will clearly face opposition from much of the committee on the idea of further rate cuts. Eric joins us now for more. Eric, good morning.
Good morning.
What are the prospect of delivering rate cuts later this year?
It is difficult. If you look at where the sort of key forecasts for the Fed were in March, core PCE, U3 unemployment, we're tracking above on core PCE and a little bit below on unemployment. So it's a difficult case. Now the question, of course, in markets is turning to, will the Fed hike rates, right? It's become a little more fashionable to talk about that. It's key to keep in mind, though, that for the vast majority of this Federal Reserve, just doing nothing is tightening, right? Rates are above neutral for most of this committee. So the market may be a little bit ahead of itself in pricing rate hikes.
Well, let's talk about that. So right now, 397 on twos. So you're trading just above the upper end of the policy rate at the Federal Reserve. Just above it. I wouldn't say it's the base case of a lot of people right now, that at least I speak to, that they expect rate hikes. How high is the bar to hikes?
I think it's quite high. I think if the Fed is going to hike, it's going to take them a very long time, and it's going to take a couple more things. One being inflation expectations, and that's out the curve, not just at the front end of the curve, right? Those really need to perk up. And, I think also you need to see very clear improvement in the labor market, not just relative stabilization. But again, I think this is a Fed that if they're going to hike, they're going to be way behind the curve, and it's going to take many months, and rather than something that's going to be proactive tightening.
So then why wouldn't you just sell the long end if you're seeing all of this capital markets activity? You're saying that this is a somewhat restrictive Fed funds rate. A lot of people in the market would beg to disagree when they're getting IPOs and different mergers getting done. You see the incredible animal spirits coming back, the consumer performing better than many people expected. Where is this restrictiveness of which you speak?
That's a great question, and I think if you look at the market reaction to the last two inflation reports, let's zero in on the yield curve. The yield curve actually steepened a little bit on some of these very hot inflation prints. That's unusual. It's not supposed to happen, and that I think is a function of the front end being relatively pinned with hikes being unlikely. Let's go back to October 2023. Think about the bear steepening we had in the yield curve back then. The Fed basically said, the market's doing the work for us. We don't have to raise rates because the long end of the curve is actually increasing. We could see something similar this time around if that's what the market does.
Is this something that you think is feasible for this Fed, given the focus on the 10-year Treasury yield from one Scott Bessent over at the Treasury? I mean, there's this question of, are they going to allow this kind of tightening, given that it disproportionately affects the areas of the economy that haven't gotten off the back foot, which is housing and a lot of mortgage payments?
Well, they may not have a choice, right? I mean, if they're not going to, if inflation is going to stay perky and unemployment's going to be stable and the back end of the curve moves higher, they can't do much of anything unless they're going to say, oh, we actually need to raise rates, right? So that's going to be the release valve until otherwise proven otherwise.
This from BNP Paribas yesterday. 5% not a ceiling. Went on to say, for yields to stop pushing higher, we think the Treasury will need to deliver something clear in the form of guidance that suggests coupon supply in the long end will be either explicitly or implicitly decreased. Someone will have to step in. This move in yields that we're seeing, I agree with you, it was notable. Curve steepened. Yields at the front end of the curve actually dropped a single basis point. That's the market convinced of a dovish reaction function, an asymmetrically dovish reaction function at the Federal Reserve, that they're willing to ignore hot inflation. I don't think it's the market that welcomes it. Hence the sell-off further out along the curve.
Yeah, is this essentially the market begging for some intervention from the Treasury? This is the speculation that they're going to issue significantly more of the debt on the front end of the yield curve. We haven't seen that yet. Is this sort of the invitation? Now is your time. Show us what you got.
This is what people are talking about. You bring down the balance sheet, because apparently this is what Kevin Warsh wants to do. It all gets issued at the front end of the curve. Rates have to be pinned to the floor, more than they otherwise would be, and the channel where this really plays out is the FX channel, and the dollar gets hammered. Now, that's just a theory. Do you subscribe to it?
Not hammered, but can it weaken a little bit? Yeah. And I think as long as inflation is rising, growth is stable, and the Fed is doing nothing, the dollar is going to stay under pressure, especially against some of the high yielders, high carry currencies. Now, at some point here, again, certainly if the Fed were to actually raise rates, that would completely change the game. But also, there still are some left tail risks or some downside risks that are out there. Some of the credit tightening that we're seeing behind the scenes in private markets. I think this is a market that's increasingly pricing in rate hikes, positioned for higher rates across the curve, especially at the front end.
Yep.
So let's not forget that there are still some of those risks on the other side of the spectrum.
Eric, it's good to see you. Thanks for dropping by. Appreciate it. Eric Nelson there of Wells Fargo. Up next, we'll catch up with Paul Quinsee of JPMorgan Asset Management, the former senior White House trade advisor Kellyanne Shaw, Eric Najarian of UBS, and Mona Mahajan of Edward Jones. The second hour of Bloomberg Surveillance just around the corner.
The economy is really strong.
What we're seeing is a narrow foundation to growth.
We're in the early innings of what could be a really problematic path for inflation.
That longevity of the inflation myths probably starts to affect the psychology of consumers.
The brunt of the pain has not yet been felt.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The second hour of Bloomberg Surveillance starts right now, and your price action of scores look like this. All-time highs on the S&P, and it's a weight to the rally, up by 0.25% on the S&P and on the Nasdaq. The tech trade bouncing back in this bond market isn't stopping it. 2s, 10s, 30s, 2s around 4%, 30s around 5%. The first fixed rate we've seen at a 30-year auction going back almost 20 years. Things are changing in the bond market, not just stateside, but worldwide. More economic data later this morning, 8:30 Eastern Time. We will get jobless claims. You will also get retail sales. An important read on the consumer and just how much spending that consumer has been doing.
Are they absorbing the price increases that we're seeing in CPI and PPI reports? Can they continue to absorb this inflationary backdrop that we continue to talk about and that you see priced into bond yields? Ultimately, the answer has been yes for most of the readings. And so is there some sort of contradiction with the idea of this roaring bull market and an inflationary backdrop and nothing on the horizon that potentially could stop it? How much does that tension become something recognized as a risk versus something that can persist for the foreseeable future?
Two-speed economy. Chris Ferro has put it well on this program. This is not a consumption-led rally in the equity market. It's a tech investment-driven rally in the equity market. And if you based your equity market thesis right now on consumption trends and lower income groups in the US, you'd be aggressively short equities. The problem is right now that the equity market is made up of some massive tech firms that contribute to a massive weighting in the S&P 500, and those companies are doing tremendously well. You base it on that, you'll be aggressively long, and that's what the market's been doing.
And they've been right, and they've been seeing semiconductors lead, and you talked about bad breath. I know, insert your bad breath joke here, but that is what you're seeing right now in this rally, that only 46% of the S&P 500's members reached above their 50-day moving averages. That is the fewest in a month, even as we reach new high after new high. It is a handful of stocks that have been the beneficiaries of this incredible groundswell of infrastructure spending and the profitability stemming from AI.
Should we talk about the vibes?
I would love to.
The 99.5 Cerebras AI chip maker. What was the range over there for that IPO?
It was supposed to be 140 to 150.
Came in at 185, right? That's some pretty powerful stuff. Cisco. People remember Cisco back in the good old days, or rather the bad old days in the early 2000s where things went the wrong way. Cisco crushing it. Really strong forecast. Stock is surging in the pre-market.
You know, it's funny, when we talk about the 2000s, I remember what it used to be a cautionary tale. Now people are saying, well, some of the winners back then actually ended up being the winners today. It just took, 2 decades of doing nothing. So, people can look at this on either level. Cisco coming back, it's still alive and kicking and actually benefiting from the latest tech trend, the AI boom. Nonetheless, people are concerned about how much capacity there is to absorb the IPOs coming down the pike. Cerebras really highlighted how much demand there is, how oversubscribed it was, pricing at $185 a share, as you mentioned, for a valuation of $40 to $49 billion, depending on how you calculate it. Does this pave the path for SpaceX, for OpenAI, for Anthropic as they continue to raise money in the private market?
Yeah, that's the biggest IPO of the year so far.
Correct.
Because later this year you might see some even bigger IPOs, not once, not twice, but maybe 3 times. Equity futures right now in the S&P positive by 1/3%. Coming up this hour, Paul Quinsee of JPMorgan Asset Management, with stocks adding to record highs. The former senior White House trade advisor Kellyanne Shaw on President Trump's meeting with Xi Jinping, and Mona Mahajan of Edward Jones after the Senate confirmed Kevin Warsh as the next Fed chair. We begin this hour with stocks edging higher as tech continues to fuel the record rally. Paul Quinsee of JPMorgan Asset Management writing, earnings are booming with AI and semiconductors driving profit expansion, not just in the US, but across regions through the broader supply chain. This is a good time to diversify. Paul joins us now for more. Paul, good morning.
Good morning.
Diversify the what or diversify the where? Because it is different.
Both. I think diversification in terms of style. So think about value as well as growth, and diversification in terms of region as well. Think about the rest of the world as well as the US.
Because region right now, I'd get excited about South Korea. I'd be diversifying the where, but not the what. What are you interested in beyond just the AI tech trade?
Well, South Korea is a couple of stocks, not a region. So look, I think, first of all, the tech trade itself, you can't ignore it, obviously, and you can't just dismiss it. And yes, we see these warning signs. One of my portfolio managers told me she was called by her college-age son and asked about last week, is it a good time to start buying memory stocks? You see incredible interest in these ETFs booming. Those are things that worry. Those of us that have been around for a long time, but when you look at the fundamentals, they're incredibly strong. And history tells us that these kind of moves go on until, first of all, things get expensive. Secondly, volatility starts to pick up. That's a real warning sign. And thirdly, the earnings revisions peak. That's when you've got to really watch out. And that's not yet what we're seeing when it comes to semiconductors. So on the valuations, sure, on things like price to book, price to sales, multiples are getting up there. But the earnings multiples are still, for many of these stocks, still single digit. And that's true in the US, it's true in the rest of the world as well. So a mixed picture there. Volatility absolutely going up. You're getting enormous moves every day in both directions. That's a warning sign. Earnings momentum doesn't seem like it's peaking. You just mentioned Cisco. Every data point we've seen in the last few weeks just fuels the fire. Things are getting better, driven, of course, by, at the root cause of it, the frontier models inflecting, hyperscaler investment going up every time you look at the numbers. That trend hasn't yet changed.
Just to add to your fear, my 17-year-old son came to me on Tuesday after the 0.7% drop and said, I bought the dip. And I said, oh, dear Lord. But to that point, how do you diversify from something that is profoundly existential and rooted through every valuation of every company? It's rooted in the bond market. It's rooted on growth expectations and productivity. What does it mean to move away from that when that seems to be increasingly embedded in people's economic and financial expectations?
Sure. Well, I'll give you an example. So we've seen investors looking a lot at international value strategies in the last couple of years. So international value is diversifying about as far away from technology and Magnificent Seven as you can get, right? So it's geographic diversification and it's style diversification. And you can look at you can put together a portfolio of international value stocks, pay around 11 times earnings. They're decent companies. They're not growing that fast. Tech is it's something like 3 or 4% of that type of portfolio. And you haven't had to sacrifice returns. So you've made 40% in the last 12 months from international value. 25% type compound return over the last 3 years. It's actually significantly better than the S&P. Now, I don't think that's a realistic expectation looking forward because the starting point is higher now. But the point is there are other ways to make money in world stock markets. Our research team covers 2,500 companies, and not every one of them, their entire fate rests on AI.
How much is it a corporate story and how much is it an FX story at a time when a lot of people are expecting the dollar to weaken?
The dollar weakening, we tend to sort of look at the world bottom-up, company by company, so I always prefer to get excited about the corporate story rather than relying on the currencies. But yeah, currencies played into that a little bit. But no, it's been much more a corporate story. So, for example, the European banks went from uninvestable to solid companies. You made 5 or 6 times your money in a few years. Energy stocks, written off a year ago, now their earnings are booming. So there are just other ways to make money in global stock markets. And I think it's at a time like this when all the attention is in one place, it's really worth remembering that.
Can I throw another asset class at you? Started with FX. I want to throw bonds at you as well. Fixed income feels a little bit untethered right now. Looking at Japan, yield levels we haven't seen since some maturity started in the late 1990s. In Germany, at any given time, yield levels we haven't seen since 2011. You've seen the stats coming out of the gilt market in the UK, highs of the year stateside. What do you think is developing there? And is that a challenge to your asset class in the equity market?
Well, we have enough challenge keeping up the 2,500 companies that we're looking at without worrying too much about what's going on in the bond markets too. But we have to be aware of it. I'm old enough to remember the crash of '87 when no one cared about bond yields until they did. That was 6 months into my career as a portfolio manager. So that was a learning lesson right there. Look, we're a long way from that kind of extreme, right? So, but what we do, our observation about the economy is when we look at earnings and corporate profitability, it's incredibly strong, but it's very concentrated. So we're going to see earnings in the US this year up mid-20s now, our analyst estimates. That's up 4 or 5 points from where it was just a few weeks ago. And yes, it's broadening beyond the Magnificent Seven.
Yeah.
So the 493 are going to be up close to 20% this year. But it's still tech. So if you take tech out, and also energy, which is obviously something different as well, you've got around 8% earnings growth. That's okay, but that's not a boom. The boom is AI. So from a bottom-up point of view, the economy looks okay, reasonably strong, but all the excitement, all the inflationary pressure, it's in the AI space.
Your asset class, though, is in a competition for flows. If I can sort of boil it down to that, you've identified a problem, concentration. I'm identifying an asset class that's offering some real income now in a way that it hasn't for a number of years, in any given place, in any given time. And I'm trying to understand whether you would see that as a reflection of a better profile for growth looking out, yields higher, curve steeper, or whether you see that as competition for flows that would otherwise go into your asset class because of the concentration risk.
Yeah, sure. There is a little more competition, right? It wasn't hard to choose between stocks and bonds when bonds were yielding 2%. We went through this long period after GFC in which bond yields were just incredibly low by any kind of historic standard, and it was kind of hard to get too excited about bonds back then. We've gone from extremely low to what our fixed income team think are more sort of normal, typical levels, so it's fine. It's not yet in the competition stage.
We've seen incredible returns, double-digit returns for a number of years now, and people are wondering whether we're entering a time of more tempered returns. Are you expecting to prepare your clients for more 8 to 10% returns on a forward-looking basis versus, the 20-some-odd% that we've seen recently?
Yes. I think that's very reasonable. So why such great returns? Obviously, fantastic earnings growth. We think that's going to continue, but at a slightly slower pace. So as we think about the next 5 years, our analysts get to around 10, 11% earnings growth a year for the S&P 500 companies. That's pretty good, but it's not 25% we're getting this year. So, and then on top of that, multiples, they've been going up at a modest rate. They're at the kind of high end of the range. That doesn't terrify us. But it's hard to imagine multiples going up a lot and building that in as part of your returns. S&P is trading around 21 times. We would think something like 18, 19 times. So it's a little bit high. It's not crazy, but I wouldn't build in from here multiple expansion. So it's all about earnings. It sort of always is, but even more so than ever when you're starting at, paying a pretty high price.
I was trying to attempt to get Paul to give Bob Michael some love on the fixed income side.
Well, I mean, not really. Although he didn't say that it was true competition. At the same time, he seemed to signify exactly what Bob's been saying, which is he doesn't see runaway bond yields because of the underlying weakness in certain parts of the economy.
Paul, it's good to see you. Thanks for being here.
Thank you.
Thank you, sir. Paul Quinsee there of JPMorgan Asset Management. Stocks near session highs, up 1/3% on the S&P. With an update on stories worldwide with your Bloomberg brief, Vonnie Quinn has more. Hey, Vonnie.
Hey, John. Thank you. President Trump and Xi Jinping wrapping up comments at a state banquet in Beijing. Trump praising the extremely positive and productive conversations, emphasizing his long-standing personal relationship with the Chinese leader. Trump extending an invite for Xi to visit the White House in September. Nvidia shares rising in the pre-market. The U.S. reportedly clearing several Chinese firms to buy the company's H200 chips. Reuters reporting companies including Alibaba and ByteDance are approved, but deliveries are stalled. And Cisco shares rising in the pre-market. The company reporting fourth quarter guidance, topping estimates by nearly $1 billion. Cisco also announcing plans to cut almost 4,000 jobs as part of a restructuring to focus on AI. And that is your Bloomberg brief. John.
Chuck Robbins just absolutely crushing it. What a report. An earnings season for Cisco. The stock is up by 16%. Up next on the program, optimism in Beijing.
I want to thank President Xi. It is my honor to extend an invitation to you and Madam Peng to visit us at the White House this September 24th.
Annmarie on the ground in Beijing joins us next. Plus, we'll catch up with the former senior White House trade advisor Kellyanne Shaw, live from New York City this morning. Good morning. Live from New York City this morning. Good morning to you all. Equity futures right now in the S&P 500 firmer by 1/3%. On the Nasdaq up by 0.28, adding some weight to a record-breaking rally. Thank you to two names this morning. Cisco in the pre-market surging 16%. Fantastic numbers. Great guidance coming from Chuck Robbins. Some job cuts, a shift to AI, all the stuff that investors want to hear right now is helping that name this morning. Nvidia also higher by 1.5%. I think we need some more clarity on what is going on here. A Reuters report earlier on this morning suggesting that the US has basically given Nvidia clearance to sell H200 chips to 10 Chinese firms. So they are export licenses. We also need to figure out whether China will allow those companies to import said chips into China. And that's where I think we lack some clarity still today.
Yeah, what's different? Because we heard about the H200 chips licenses for Nvidia being sold. Also curious to understand exactly what some of the people back in Washington, D.C. will say. We were talking with Eddie Fishman yesterday, who said that the people in Washington who had to deal with national security were very concerned about Judson Huang joining President Trump on this trip. And now I just wonder if there's going to be sort of a pushback on both sides as well.
Nvidia in the pre-market higher by 1.5%. Under surveillance this morning, some optimism in Beijing.
I want to thank President Xi, my friend, for this magnificent welcome. And it really was a magnificent welcome. We had extremely positive and productive conversations. It is my honor to extend an invitation to you and Madam Peng to visit us at the White House this September 24th, and we look forward to it.
So here's the latest this morning. President Donald Trump extending an invitation to the Chinese President Xi Jinping, the two leaders participating in a state banquet following discussing trade and Iran last night. Annmarie has the latest in Beijing. Hey, Annmarie.
Hey, John, good morning. What you're seeing right now is just absolutely warm ties, optimistic praise Xi Jinping has regarded in terms of President Trump and this toast this evening, as well as from President Trump and extending a state visit to President Xi Jinping. The last time he was in the United States was in 2023. That was on the sidelines of the APEC summit. He met with President Biden, of course, after the whole debacle with the Chinese spy balloon. But he hasn't had a state visit since 2015. Of course, this would come as well ahead of the midterm elections. So potentially a delicate matter for this White House. But I will say it's almost shocking to see the showering of praise and the warm relationship between these two leaders. Would you have guessed that more than a year ago, we were in this tit-for-tat trade war, export controls, what to do with highly sensitive AI technological chips, what was happening in terms of Chinese purchases of energy and agriculture, the sky-high tariffs? All of that seems to be unwinding during this summit, during this trip. Of course, there's a lot of still questions to be answered. They're going to have another day tomorrow. I think top of mind for most observers is going to be what the president says about Taiwan. While the bilateral meeting was happening today, we had a readout that this was the biggest issue that Xi Jinping brought up in the meeting and said if it's mishandled, it can mean a dangerous conflict between the United States and China. When you look at the White House reading, there was no mention of Taiwan.
AMH on the ground in Beijing. Annmarie, thank you. To build on this conversation, the former senior White House trade advisor Kellyanne Shaw writes the following. We have a long way to go in terms of navigating the future of US-China relations. Many of these conversations will continue well past September when the two leaders meet again on US soil. Kellyanne joins us now for more. Kellyanne, welcome to the programme. Annmarie has alluded to this a few times, that this leader in China has taken a more assertive stance on Taiwan at this meeting. With that in mind, how sustainable is this more stable phase of relations between the two countries?
Yeah, good morning. I think this is the most highly anticipated leader-to-leader conversation of the year. Now, certainly there have been a number of mentions of Taiwan, predominantly on the Chinese side as part of the readout. And this was some of the fear on the U.S. side going into this meeting, that we might see President Xi lean on President Trump to get some sort of concession when it comes to Taiwan. But what I'll say about Xi's comments is this is not unusual. And I think back to the last phone call that the two leaders had, the Chinese readout was almost entirely focused on Taiwan and weapons sales. It is not unusual for the Chinese to emphasize this. The U.S. on the other side is basically not saying anything at all as part of the formal readout. And then you had Secretary Rubio just a few moments ago talking about the fact that the policy on the U.S. side has not changed. So while this will continue to be a pressure point, and it's one that we're watching very closely, I don't think anything has shifted, at least not yet.
Well, let's talk about things that might be shifting right now. The Chinese leader talked about China opening more to trade. We've been talking about that for ages. The more intriguing part of this is everyone else shutting the door to them. We heard from the Treasury Secretary speaking to the press earlier on this morning, who talked about Chinese investment and saying this: what we want to do is make sure that some of these investments don't get referred to CFIUS. Kellyanne, are things changing on that front?
Yeah, and this is one of the points that I was watching the most carefully in terms of what would come out of this summit. There have been a lot of talk about the Board of Trade and trying to manage the flow of goods going back and forth between the two economies. But there was really not a lot of clarity about what the investment commitments would look like. And frankly, a lot of concern by U.S. lawmakers, by stakeholders, that the president might allow more Chinese investment into the United States. And so I found this comment really curious as well. Now, to the extent they are talking about investment, and to the extent they're talking about the fact that there may be some transactions where there's really no national security nexus, they want to make sure that CFIUS is being used and calibrated appropriately. Maybe that's less concerning, but if what we're talking about is allowing large Chinese investments into strategic sectors in the United States, that's going to be very concerning for the president if he gets back home to that kind of outcome.
We've also heard that there is some sort of, or at least speculation from the likes of Julian and Emanuel earlier in the show, that there could be some sort of trade tech for oil, technology investments both into China in the form of selling chips and possibly China in the U.S. in favor of some sort of help with the Strait of Hormuz. Are you expecting anything on that front?
So my expectations overall for this summit were relatively low in terms of outcomes. I think the administration has forecasted for weeks, not much to see here. We're enforcing the Busan deal. And the fact that Johnson Wong was not included on the initial delegation list made it seem more likely than not that export controls would not be part of any sort of outcome. But of course, it wouldn't be a G2 summit, a Trump-Xi summit without a little bit of drama and some surprising deliverables at the end of this. So we could see some sort of broker deal around these things, but it wasn't part of the formal negotiating agenda going in. So I'll also be curious to see what comes out of a potential transaction that way.
Right now, how much do you expect China to reciprocate and come to the United States on September 24th, as the president has requested or invited?
Yeah, I think this has been on the calendar for a while. These two leaders will likely meet face-to-face 4 times this year. So I have every expectation that President Xi will come to the United States this fall. The two leaders will meet again later in the year as well. This is a very robust year in terms of potential developments. But what I will say is this is about managing the relationship. It's about keeping an otherwise rocky situation as stable as possible. These two economies are still going in very different directions, particularly in strategic sectors. And so having that leader-to-leader touch point keeps the connectivity, keeps the stability without this whole thing falling off a cliff. And I think that's in the interest of both sides, and that's where both leaders are thinking.
Kellyanne, I'd go one step further. It's in the interest of the world to make sure there is never a direct conflict militarily between these two superpowers. But we have to face the reality. The reality is this has been an adversary that supports adversaries of the United States, including Iran. How do we tackle that issue this year?
Yeah, I mean, Iran, I'm not really expecting any sort of joint announcement by President Trump and President Xi on Iran, other than the fact that they are both seeking some sort of de-escalation and opening of the Strait of Hormuz and something to try to address the energy costs as well as the ongoing conflict and to prevent it from spreading. Now, that said, both sides do have an interest in de-escalation. And so I think that behind the scenes and in non-public ways, we are going to see some cooperation come on the back of this. I completely agree with you that it is in the interest of the world to not have any of this break out into broader direct conflict. And I think that's what both sides are trying to do in their own way while continuing to compete on economic and national security areas where it matters as well.
Kellyanne, always good to see you. Thanks for catching up with us. The former senior White House trade advisor, Kellyanne Shaw. As we've been having this discussion, Marco Rubio, Secretary of State, speaking to NBC moments ago, saying we're not asking for China's help on Hormuz and that the President, Trump, and the leader Xi Jinping have found common ground on Iran.
Yeah, the common ground being that they would prefer there not to be any kind of blockade in the Strait of Hormuz, which is lovely. Whether that actually results in action, again, remains to be seen.
Also, as Kellyanne said, indicating policies on Taiwan have not changed. Secretary Rubio going on to say arms sales to Taiwan were not prominent in talks with China. Coming up next on the programme, we'll catch up with Erica Najarian of UBS as financials continue to underperform. Record highs on the S&P 500 and the Nasdaq as well, adding some weight to that rally, up by 0.2% on the S&P. On the Nasdaq, up by 0.15%. The Russell up by a muted 1/10%. In the bond market, the drama the last 24 hours. CPI was hot, PPI was much hotter than expected, and yet we moved a basis point in the other direction on twos, which is interesting. Very, very briefly breaching 4%, then dropping back down again this morning by a few basis points, 395.84. A market that looks at that data, acknowledges that not all of it will get passed through to PCE, but ultimately the bar to hiking is still very high for the Federal Reserve. So where have I got flexibility? Further out along the curve, 30s pushed higher, north of 5% still, the curve a lot steeper, or fairly steeper. And now you've got auctions, a 30-year bond auction where we see a fixed rate of 5% for the first time since 2007. It's been a long time.
Yeah, so there are a couple of responses potentially to this. On one hand, a Fed that could hike, which a lot of people have written off as an improbable outcome based on what you just said and, frankly, market expectations. The second thing, the relief valve in the long end. And then the last thing is, if 30-year bonds are going to sell at such a low price, high yield, just don't sell them. And that might be what the Treasury ends up doing. I will just note, Susan Collins, the Boston Fed president, came out yesterday and said, more than 5 years of above target inflation has reduced my patience for looking through another supply shock. And she said it is not in her most likely outlook, but she could consider a rate hike if this does persist.
I was going through some of the numbers from the teams on the 30-year bond auction. The lowest one we've seen, the lowest fixed rate, 125 back in May 2020. And of course, that particular bond now trades much, much lower because of how much higher yields are at the moment. The note from BNP really got my attention. I want to go over this quote again. 5% is not a ceiling. There's a belief that 5% is somehow a ceiling for the 30-year. They don't think it is. They think for yields to stop pushing higher, we think the Treasury needs to deliver something clear in the form of guidance that suggests coupon supply at the long end will either be explicitly or implicitly decreased. That's a bit of pressure on the Treasury, not on the Fed chair.
A lot of people are talking about the Fed Treasury Accord, right? The idea that the Treasury is going to issue more in T-bills is going to cast away the 30-year bond, because why should you sell bonds at such a high coupon that you've got to pay out that could potentially supersede some of the spending plans that the U.S. has? So just bring that down to the front end, have the Fed deal with its situation in certain ways, keep rates where they are so you lower your borrowing costs, and call it a day. The relief valve, as you pointed out, is the dollar. And do you get a much weaker dollar as a result? Some people say, as we were just talking to Eric Nelson, not much weaker. Depending on what you're comparing it to, maybe it's a different story.
If they're explicit about that accord and people latch on to that, you'd have to believe the dollar would get hammered.
Yeah, Petro one.
My language hammered. Eric Nelson of Wells Fargo didn't like that language, but that would be the theory.
Yeah, and versus what? And I think that is a key question. Who is the next power to kind of take on some more reserve status? China trying to take that away from Europe, which evidently is having a bit of issues.
Things are somewhat calmer this morning, at least. DXY at about 98, yields a little bit lower at the long end of the curve. As we count you down to the opening bound, nothing calm about these moves. Some major moves in the pre-market. Yahara has more. Hey, Yahara.
Hi, John. And with this move, Cisco is set for its biggest post-earnings jump since 2011. The networking giant delivering a beat and a raise and announcing that it is cutting thousands of jobs as it shifts resources toward AI. This is a company that trailed many of its peers out of the gate when it came to the AI boom, though it is now catching up and it is raising its forecast when it comes to AI orders from the hyperscalers from $5 billion to $9 billion next fiscal year. Turning to Nvidia, it is bucking the rest of the chip makers, which are mostly lower today. It is up 1.6% on a flurry of headlines out of Beijing. First, you have President Xi telling business leaders, including Jensen Huang, that China will open its door wider to foreign companies. They have heard that before, and the barriers remain. And then you have this Reuters report saying that the U.S. has approved the H200 AI chip so that Chinese firms can now buy it. But as we know, the U.S. was never the problem. It was China, and we don't know whether it has signed off on that. And we end on shares of Wolfspeed. They are surging 3.75% this morning after a 16% surge yesterday, now headed toward 8 days of gains. And the catalyst coming after the research firm Citrini named this chip maker as a major beneficiary of the AI boom as it comes out of bankruptcy. John?
Yahara, thank you. Remember Citrini? All the worries about that?
Yeah.
I love the research coming out of that firm.
Well, I still think about that idea that we're all going to be without a job and the potential doom that we all
Still
are
haunted
toward.
by that, yeah.
I mean, it still is a conversation, frequent conversation.
At Casa Bramo, around the dinner table.
All right, we don't have to go back.
Think how many crises we've had so far this year.
Every night
overwhelming. We're about to talk about the banks, and I was reading through Eric Najarian's research, and I was just thinking, remember when we were worried about capping interest rates on credit cards? Remember that? That was earlier this year.
Oh, God. Was that really?
Yeah, people were saying don't buy the banks because these things are on the table now for the year ahead.
Yeah, that wasn't this year. That was 2001.
Feels like 25 years ago.
I mean, it's just, like, honestly, I don't understand time right now.
On our radar this morning, Xi Jinping warning President Trump that mishandling the Taiwan situation could trigger a, quote, collision or even clashes. The blunt remarks injecting some tension into an otherwise cordial Beijing summit. Elsewhere, according to Reuters, the US reportedly clearing several Chinese firms to buy Nvidia's H200 chip. The CEO, Jensen Huang, telling us here at Bloomberg the US-China summit has been an incredible opportunity to build a better partnership between the two countries. And finally, AI chip maker Cerebras will officially hit the public market today in the largest IPO of the year so far. The company pricing shares well above expectations at $185, giving it a market value close to $40 billion.
Yeah, raising about $5.5 billion in this IPO. So there are a couple of takeaways. Number one, if you're a chip maker, well, it is your time to shine. And if you want to raise money, now is your moment. So who else is going to come to the table to raise money? Is this setting the tone for SpaceX, for OpenAI, for Anthropic to come later this year? Even as there is some skepticism about levels, valuations, how far some of them have gone. I'm thinking about OpenAI losing some of its clout to Anthropic. Nonetheless, the fact that this was seriously oversubscribed put to bed all the worriers out there saying that this couldn't get done and really opened the door to what could get done later this year.
Some banks very excited about the year ahead. Let's talk about the year ahead for the financials. Erica Najarian of UBS writing the following: we think big banks could swing firmly back into favour versus regionals as investors contemplate the bargain bin following the sector's historic level of recent underperformance. Erica joins us now for more. Erica, good morning. Good to see you.
Morning.
Things have changed.
Yeah.
So last time we spoke, we were talking about those kind of issues. We were talking about the opportunity in the regionals, maybe not the major players. What's changed?
Iran and inflation, right? The two big eyes. So obviously higher gas prices is really, putting like a kink in terms of the consumer spending that was supposed to be fueled by these tax returns and tax refunds. And so that's clearly an issue. Additionally, the secondary effects are going to be significant. If you want something delivered, like transportation costs, all of a sudden the shipping is $13.95, maybe not free, or $9.95. And, I don't know if I want to add to cart if the shipping's not free. But regardless, I think that that's going to be an issue. And obviously, there are no cuts in the curve. There's a greater probability priced in of a hike rather than a cut this year. And so what investors are saying, wait a minute, for us to have invested in regional banks, we needed a steep curve as well. And so again, I think the G-SIBs become the hiding place, especially since, you just talked about, a large IPO, especially since the capital markets construct is still super robust, even taking into account a very slow April.
Within the major players then, does that make a Goldman and Morgan Stanley a little bit more compelling on the margin now?
Well, absolutely, right? Because they're pretty much, just to oversimplify it, they're in the moving business, not the storage business. And if the concern is, okay, the consumer strength might be weakening, additionally, deposits might be more expensive, then you'd rather be in a transaction-based business rather than a balance sheet-based business. And that's why, even in the ugly days, Goldman and Morgan Stanley, Goldman more so, they've been like Teflon. They've just been up there on the screen green, where every other bank has been red, even JPMorgan.
Well, do you see this as actually the likely bifurcation, that you want to be in the moving business rather than the storage business? Or do you see some of the concerns about consumer weakness as being overblown? I remember the private credit issues that happened about, 4 years ago that have seemed to have evaporated, or the idea that potentially people aren't spending, which will be put to bed in about an hour when we see the retail sales. What's your sense of that?
I think that's a great question. I think the answer is yes, but it's hard to disprove the negative right now until you see sort of firmer numbers. Because while we'll get the retail sales number in a little bit, you've also seen some monthly credit card data that have implied that May was sort of a weak month for spend. Now, the banks and the card companies would argue that this is just sort of a reallocation of spend, so spending more in gas rather than everything else. But at some point, something will break. Right? But also, I think some of the concerns over higher rates and deposits, again, it's an opportunity for the other G-SIBs, like a JPMorgan, like a Wells, like a Bank of America, where they've been sort of really underperforming Goldman and Morgan. And I think the concerns on the deposit side and the consumer side, at least for them, are overblown.
Do you think that we can consider some of these banks tech stocks increasingly as they invest billions and billions of dollars in different technologies, potentially they could start to cut staff. We've already seen the financial sector contract in terms of the total overhead. How much is that a tailwind that people haven't fully priced in?
I mean, that would be awesome because I get paid in bank stock, but I think the answer is unlikely, right? Here's the thing. You always have credit risk as an overhang, right? So that's always going to cap your multiple. Secondarily, like Jamie Dimon always says, and he cops this from Jeff Bezos, your margin is my opportunity. And even if they have improving, cost to income ratios in one part of the business because of AI and technology, the best managers will invest that somewhere else. So this notion that you get to keep all of the savings and then get a higher, I would love to believe that, but I don't think that's going to be the case.
Can we put some numbers on it, rough estimates? Look at staff levels now. Where do you think they'll be a year from now, 2 years, 5 years from now? How do you think about that trajectory at these big institutions?
So remember, we're a regulated industry. So let's say you can get rid of, 10%, 15% of your call centers. All of a sudden, utilizing AI in retail requires you to have more supervisory, more compliance. And all of a sudden, maybe you're not replacing headcount one for one at all, but you're replacing, call center headcount with something that's more expensive, somebody with a license, somebody that can oversee. So I'm not sure that this is necessarily going to be this, in 5 years, there's going to be 30% less headcount. Now, there could be 10% less headcount, but I'm not sure the cost per employee necessarily comes down.
We've been seeing those headlines come out of some tech firms. I stress some tech firms. I've always been wondering when we would see them cross the Bloomberg with regards to a large financial, and then the next would follow, the next would follow. But having this conversation, it doesn't sound like that moment's very close.
My guess is that it might happen, but it might not be advertised as such, right? I mean, you already are seeing attrition, and you're starting to see the numbers of total financial employees tick down, I believe about 100,000 over the past year or so, if you take a look at the BLS numbers. So clearly there has been attrition. Whether this comes as some sort of wholesale advertised cuts, that becomes political, and so you probably don't want to do that. But who isn't being replaced? Which new entrant isn't going to be trained or isn't going to be hired full time? These are some of the questions that people have been asking.
Erica, it's good to see you. It always is. Thanks for being here. Appreciate it. Erica Najarian there of UBS on the financials and a future of these institutions. Let's give you an update on stories worldwide this morning with your Bloomberg Brief. Here's Vonnie Quinn. Hey, Vonnie.
Hey, John. Thank you. President Trump and China's Xi Jinping wrapping up comments at a state banquet in Beijing. Trump praising their, quote, extremely positive and productive conversations, emphasizing his long-standing personal relationship with the Chinese leader. Trump extending an invite for Xi to visit the White House.
I want to thank President Xi. It is my honor to extend an invitation to you and Madam Peng to visit us at the White House this September 24th.
The leaders also set to meet in November and in December. StubHub shares surging in the pre-market. The ticketing company reporting first quarter revenue that beat Wall Street estimates. StubHub also saying it's on track to achieve its full year guidance as it, quote, grows globally and increases profitability through greater scale. GameStop CEO Ryan Cohen is planning to take his takeover offer directly to eBay's shareholders. The Financial Times reporting Cohen plans to put the offer to shareholders soon. The report coming after his request to meet eBay's board of directors was rejected. And that's your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in about 30 minutes' time in the next hour. Up next on the programme, awaiting the Warsh Fed.
It'll be a pretty high bar for Warsh when he comes in to build consensus around the idea of rate cuts anytime soon.
There's only so much, of course, that Kevin Warsh can do as chair. He's only one vote.
Up next, we'll catch up with Mona Mahajan of Edward Jones, live from New York City. You're watching Bloomberg TV. We are allflation and no stack. CPI, PPI coming in hotter than expected. GDP growth numbers right now, pretty good. We'll get retail sales in about 40 minutes time. Equity futures on the S&P 500, all-time highs coming into Thursday morning, higher again by a third of 1% on the S&P, on the Nasdaq up by a quarter of 1%. In the bond market, things get more and more interesting. Twos around 4%, 395 this morning, down by 2 basis points. Kevin Warsh stepping up to the plate. Under surveillance this morning, awaiting the Warsh Fed.
Kevin Warsh was going to inherit an already difficult position.
He's going to want to be cutting interest rates, and the focus on trimming inflation may not necessarily convince everybody.
It'll be a pretty high bar for Warsh when he comes in to build consensus around the idea of rate cuts anytime soon.
There's only so much, of course, that Kevin Warsh can do as chair. He's only one vote.
Here's the latest this morning. The Senate confirming Kevin Warsh as the next chair of the Federal Reserve with a 54 to 45 vote, the slimmest confirmation margin for a head of the U.S. Central Bank. Mahajan of Edward Jones writing divisions will make it hard for incoming Chair Warsh to build consensus for rate cuts in the near term. Mona joins us now for more. Mona, good morning. Good to see you.
Good morning.
Assuming he's going to push for those rate cuts, do you get the sense he will?
You know, look, I think with inflation coming in as hot as it is, as the labor market and GDP growth coming in above expectations, as earnings have been flying, I think the case for a rate cut here gets tougher and tougher, even for Kevin Warsh Fed. Now, all that being said, could you make the case that we are still somewhat restrictive and above neutral, and over time, Fed funds rate probably is 3.5% or so? Perhaps, but I think he's going to have to wait, be patient, and look for those signals.
Is that a problem? Is this a rate cut dependent bull market? Doesn't feel like one.
Yeah, I would agree with that. I don't think it is. In fact, I think we are doing quite well at 3.75% here. No problem with earnings or margins, certainly no problem with a consumer that is out there spending, corporations that are out there borrowing as well.
Which raises the question, if this is truly a restrictive policy, where are we seeing the restrictiveness?
Yeah. And look, I think last year there were some doubts around the labor market. We saw some softening. There's been a reversal in that labor market this year, surprisingly so to some. In fact, with new jobs created, with unemployment rate hovering around 4.3%, that labor market story is remaining intact. If there was a case for a rate cut, I would say the Fed wants to make sure they don't see a meaningful deterioration in that labor market. If there are any signs of that, that's when we start to see some movement, I think. So.
What were you doing at 1 p.m. yesterday? Were you buying some 30-year bonds?
I was watching the auction, which was great.
Well, good, I'm glad. But were you actually buying? Or are you a buyer of them at 5% yields?
Look, I think right here, our range for a 10-year Treasury for this year has been 4 to 4.5%. And we're very happy that this 10-year has stayed right in that range. As soon as we hit that 4.5% mark, we see those buyers come in. We see yields start to move down. And as soon as we hit that 4%, we think there's some caution there as well. So we think that range remains intact. We will say if we get meaningfully above 4.5% for whatever reason, that extension of duration makes sense to us.
Did you notice that she didn't mention 30 years? She just went straight to 10. Oh, yes. Sort of this one denomination she doesn't want to touch.
Benchmark.
Not alone, by the way. There are a lot of people who share that view.
Correct. We saw that yesterday in terms of the data.
Does 450 become a challenge to this equity market?
You know, we think we have to get closer to 5% to really see that pressure on not only valuations, but that softening in margins and earnings compression as well. So we're not there yet.
The one complaint we hear about this equity market is concentration risk and negative breadth. The question we often ask, is that a feature or a bug? Do you really want to be outside of the big winners right now? Do you really want to shift away from those big names that are driving massive returns?
Yeah, you know, look, those big names have been the drivers of this earnings growth. The 27% we've gotten this quarter, areas like tech and comm services have been 40 to 50% plus earnings growth for Q1. Phenomenal numbers. So those are underpinning the equity market for sure. We always say, you know, one of the key features of the U.S. equity market is its ability to innovate and to house those innovators. So all the Mag 7 are housed in the U.S. We're not seeing that innovation really play out in other parts of the world. So certainly right now we're hearing more from China and emerging markets. That's another area that we like if you want an alternative to U.S. technology. But all that being said, we remain overweight U.S. large cap, mid cap, and we like parts of EM.
Is that an alternative region or an alternative style? We asked this question in the last hour. I think it's a really important one. Financial news right now is dominated by people telling our audience to maybe look outside the US, in other regions, but maybe also other styles. Because in other regions right now, I can buy Asia, but Asian tech. What am I buying outside of technology?
You know, it's a great question. Look, we also like parts of international small and mid cap. And part of the reason is, one, we do think over time some of the productivity gains from AI will spread to other sectors. So whether it's healthcare, financial services, industrials, and a large part of Europe is exactly those sectors. And so over time, we want to make sure we have exposure to not only the winners of AI, but the sectors that'll gain from productivity.
Hold on a second. Are you saying you're overweight Europe?
International small and mid. We're underweight large because of the relative and probably the innovation story, to be honest.
So the person who we were talking about that with was Paul Quinsee of JPMorgan, and he had really a lot of optimism about the global story and about diversification in that way. But he also said that he didn't expect returns to be as good as they have been over the past few years. He expected more of like a 10 to 11% return rather than last year's 17% return or the year before the 24%. And again, the year before that, the similar kind of move. Do you agree? Do we have to lower expectations for the types of returns from equities?
Yeah, look, broadly, in the U.S., we've seen 3 years of double-digit gains. And in Europe and international, the last year and a half or so have been outperforming the U.S., those returns. And so it has been a really nice story. Now, do we expect the pace of gains to continue to that extent? Probably not. We are seeing, however, the same earnings story and earnings rebound we're seeing in the U.S. We are seeing it in the rest of the globe, and we're seeing it in Asia, in Europe. We're also seeing it in small and mid-cap stocks. So there is an earnings re-acceleration that is a tailwind for equities, we think, in the next 12 to 18 months. Beyond that, we think there could be a bit of cooling.
Paul was talking about European banks. European banks have been on quite a run. 2023 up 20%, 24 up 26%. Last year, European banks were up by 67%. They have had a massive move over the past few years.
Yeah, they've gone from instability to very much stability, and now a question of consolidation as there is more of an effort to create a greater buffer against any kind of crisis. The idea of bottom up and looking at different companies to understand what can succeed. But what Mona's talking about, which is that you're seeing profits inflect higher around the world, kind of goes counter to the narrative that we hear from some places, which is that the global growth picture is deteriorating. So which is it, right? Can you have this kind of recovery story if you don't have the participation of economic data that seems to be surprising to the downside?
I think Samsung and TSMC have offered a helping hand to global profits.
Well, I would agree with that. And how much, again, can you get away from the AI story? How much is this AI in another way or told through another side of the balance sheet?
Manu, it's good to see you. So
absolutely. Thanks,
good
guys.
to catch up. Thanks for being here. Manu Mahajan of Edward Jones. Coming up on this programme, this is the lineup for the next hour. We'll catch up with the Fed Governor Stephen Miran, Jonathan Krinsky of BTIG. He's got some things to say about the chip rally, why he thinks this chip rally could reverse, and we could see a 20% decline in the semiconductor index. We'll talk about that in a moment. Nita Richardson of ADP joins us to break down the economic data, retail sales, jobless claims. Looking forward to that. We'll hear from Julie Biel as well. Governor Miran, it's like the exit interview, his last broadcast conversation as a governor of the Federal Reserve. Looking forward to this.
Very much so, especially considering discussions around needs to change the Federal Reserve and the way that it operates. Someone who is inside, who has been critical of this institution, giving his sense of what needs to change and what he newly appreciates.
Looking forward to catching up with him in just a moment. Equity futures right now, the S&P firmer by 1/3%, higher by 0.2 on the Nasdaq, up by 0.2 also on the Russell. From New York City this morning, good morning. The third hour of Bloomberg Surveillance is up next.
Stocks are going to continue to go higher.
Do you want to be in this market? Do you want to be riding this? Yes.
This is still a market with a lot of cash on the sideline.
We're doing our best to enjoy this sort of nirvana that markets are benefiting.
There is a lot of optimism built into the market, which does create vulnerability.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now. Your scores look like this. Equity futures adding to recent gains, up by 1/3% on the S&P, record highs on the Nasdaq 100. All-time highs again this morning on the cards, up by 0.2%. In the bond market, new levels for you. 5% on 30s. We're holding on to them, rejecting 4% on 2s. Intriguing. We're down 2 basis points, even with that hotter CPI and PPI data through this week. 395.63 on a 2-year. Heading into more economic data later this morning, 8:30 Eastern time. We will get jobless claims and retail sales.
Yeah, how much is the consumer strong enough to maintain the inflationary pressure that that we've seen in CPI and PPI. One of the reasons why maybe we're seeing the bond market take a breather at the front end of the yield curve is because even hawkish Fed members have come out recently and said their base case is just to remain on hold for a longer period of time, not to hike rates. So even Susan Collins, who comes out and says, essentially, don't fool me again with another supply shock, says this is a reason why I'm not going to cut rates anytime soon. So people seem to be taking the chance of a rate hike a little bit off the table.
The bar is a lot higher than people think for that rate hike, and I think that's been reinforced by some of the communication we've had from Federal Reserve officials so far. As for the data at 8:30 Eastern Time, I said allflation, no stag. We talked about the worries of stagflation. We've had deflation. What about the stag? These consumers, based on the credit card data we've seen from Bank of America, they're still spending.
Yeah, and particularly at the upper level of the income sphere. This is a reason why some people would have said if we hadn't had the oil price shock, this would have been a boom economy. You would have seen real growth. You've started to see the employment market pick up. There is one little fly in the ointment, which is that the May credit card data has shown a softening. Consumer sentiment has softened. There are signs that maybe around the margins you are seeing a bit of the stag. Just it's overwhelmed by the AI-flation and the AI growth that seems to kind of knock that out of the picture.
That data moments away, 8:30 Eastern Time. Coming up this hour, we'll catch up with Fed Governor Stephen Miran with an uncertain path ahead for interest rates. Jonathan Krinsky of BTIG on the risk of a massive pullback in tech stocks, and Nita Richardson of ADP reacting to the latest read on the US consumer. We begin this hour with stocks adding to record highs at a pivotal moment for the Federal Reserve. Rising inflation complicating the rate outlook as a new regime takes hold at the top of the central bank tomorrow. Joining us now in his final broadcast interview as a member of the Federal Reserve Board of Governors, Stephen Miran. Governor Miran, good to see you, sir.
Good to see you. Thanks for having me back.
We've got a moment to step back and sort of reflect on your experience at this institution. We've talked lots about how you've been received externally. Can we just start with how you've been received internally over the last few months?
Sure. This has actually been one of the biggest surprises, given all the drama at the beginning. I've been received internally, I think, very, very politely, very cordially, and very kindly. And I think folks have largely enjoyed some of the intellectual conversations, some of the challenges that I've leveled against some of the ways that there had been thinking beforehand. And I think that the overall response has been, very welcoming and very kind. And that's one of the things that I'm most grateful for.
What are the kind of ideas that have been received well, that are shaping debates right now that will linger and continue beyond your departure?
Yeah, sure. So so an example of one of those things is the importance of regulations for determining the supply side of the economy. I mean, we spend a lot of time, out in the financial world, out in policy, discussing the effects of a 33 versus 35% marginal tax rate. But the truth is that regulations are often infinite taxes. And being told you're not allowed to do something versus you are allowed to do something is a very, very strong difference. And this had played a very small role in a lot of the modeling discussions happening at the Fed, in a lot of the outlooks that I heard people present. And I came in and really hammered that idea, and I think sort of moved it forward. And now a lot of people talk about it very often, internally and externally. And, sort of talk a lot about supply shocks. This is a positive supply shock that is unfolding and continues to unfold and will, I hope, mitigate some of the negative supply shocks we also get hit by.
Well, let's talk about another supply shock, and I think it's been central to some of the arguments you've made on the committee, and that's population growth. The negative population growth that we've seen, which has lowered the break-even rate for the labour market and contributed to arguments in some places for hotter, stickier inflation. You've taken the other side of that. Can you just explain that for us?
Yeah, so I think this is a really subtle issue with a lot of moving parts. Now, at a very high level, what I would say historically is that we've seen a lot of countries in different places have declines in population growth rates and stagnant populations or shrinking populations. And I think the cross-country and historical evidence is that it's unambiguously disinflationary or even eventually deflationary. Now, there's a few ways that works. One is by reducing, there's a few consequences of lower population growth. One is it does reduce the break-even payroll growth rate. So the number of jobs you need to create every month to hold the unemployment rate constant, that does come down. That's a mildly hawkish implication because it means you shouldn't get so concerned about very, very low job creation rates. However, there's also dovish implications as well, which are that it lowers the neutral rate. It brings interest rates down over time, and we've sort of seen that across countries and historically to be the case. And it's also disinflationary through long-lived capital and consumer goods. And if you think about something like housing, right, the supply of houses is relatively fixed in the short run. And if you throw millions of new people into an economy, you're going to drive up the price of rents because they need places to live. Right, you're going to create inflation, and that inflation is very, very persistent because of the way that housing inflation is calculated. It's very, very sticky. If you have declining population growth, you don't need as much home price growth, and that very inflationary tailwind gets taken away and ceases to be a major driver of inflation. And I think you've been seeing that start to play out in the data. Market rents in this country have been growing at a 1% rate for the last few years. This is one of the biggest components of the inflation indices. And I think you're going to continue seeing measured PCE and CPI rents and measured PCE and CPI shelter inflation continue to converge down to those very low levels. So I think there's one hawkish implication, which is the lower break-even payroll rate, but there's also some very dovish implications, because it reduces the neutral rate and it brings down inflation through some of these long-lived capital and investment goods.
This is a longer-term structure for how to think about inflation and the benchmark rate of the Federal Reserve and how it sort of it works with the sort of long-term inflation rate. Near term, though, one thing that you've been known for, a hallmark of your time on the Fed, was that you voted to cut rates at least once at every single meeting. Do you think that that still holds, even though in the short term, it does seem like the inflationary shock is overwhelming potential structural changes that could lead to disinflation?
I do, and I think this is maybe one of the biggest differences between me and a lot of other folks, is that I take very seriously the idea of monetary policy lags. Very, very seriously. Monetary policy doesn't hit the economy right now. If we changed interest rates today, it wouldn't flow through into the economy until 12 to 18 months from now. Right now, there's some disagreement over exactly how long those lags are, but I think 12 to 18 is the consensus view. And therefore, for any shock that's hitting the economy today, you can't think about what the effect in the next few months is. You need to think about what the effect in the next 12 to 18 months is. And the effect 12 to 18 months out. So if oil goes higher, it's a supply shock. Straits of Hormuz are closed, right? That's going to boost the oil price today, and with it a bunch of other stuff that's very tightly tied to energy prices, like airfares, right? That's going to go higher very quickly within the course of a few months, and we've been living through that, and that is very real, right? There's no way that is very real inflation, but it is not inflation that monetary policy can affect. Monetary policy can affect 12 to 18 months from now. So there's got to be a reason that you think airfares and oil prices are going to be moving higher in the summer of 2027. In the fall of 2027, not the summer and fall of 2026. And so it's those lags that really should be driving where you think about forward-looking monetary policy should be. And that's a lot of what I've tried to hone into when thinking about population growth and deregulation, and saying that the traditional view that we should look through in oil shock should prevail. This is very, vanilla, basic, traditional monetary policy.
Part of the problem is that the market doesn't agree. At least not in terms of where longer dated bonds are trading and where yields are shifting, where you see them shifting higher even as the front end stays where it is. Do you think that in this type of environment, it's imperative to have some sort of Fed Treasury accord akin to what people have been talking about, where the Treasury steps in to sort of influence the long end while the Fed cuts rates on the short end?
So let me address those separately. So the market not agreeing is in part a Hall of Mirrors issue, because if the Fed says we're very backward looking and inflation over the last 12 months is going to determine policy that affects 12 to 18 months from now, meaning the economy in 2027 is affected by data in 2025 in that world, right? So very, very backward looking. If that's how the Fed communicates that it's setting policy, then the market is going to start to reflect that. And so the market reflecting a lack of interest rate cuts, right, is in part because the Fed is telling them we're backward looking, right? And so that's going to create a self-reinforcement problem. Now, on the Fed Treasury Accord, so first of all, I won't be involved in that if it happens, but, I have done some work on the balance sheet, and I do think it is important that one of the problems with having a very large balance sheet and lots of securities, lots of Treasury securities on the Federal Reserve's balance sheet, is it does start to get the Fed involved in questions that have some fiscal implications, right? If we own a huge chunk of debt, then that means that we're impinging on decisions that traditionally are the realm of the fiscal authority. What is the distribution of public debt that it issues that's held by the public? And so I do think it is important that if you have a large balance sheet, there needs to be sort of some clear delineation about who's doing what. And to me, these questions are really murky, and they implicate independence to an extent, and therefore it's one of the reasons among many that I would favor having a smaller balance sheet.
How close do you think the Fed should work with the Treasury to achieve that? How closely should the Fed work with the administration?
Yeah, so my view is that the Fed having a big balance sheet starts to implicate a lot of those lines and becomes problematic. So the Fed should strive to have as small a balance sheet as it can, right, to achieve its goals and implementation framework. And if we can sort of improve that implementation framework and make it smarter to reduce the minimum size of the balance sheet that we need, then that's a great thing. And that was a major thrust of the paper that I wrote in the spring with Alessandro Barberino and Anthony Dirks and Alyssa Anderson. And so that was a major thrust of that work. That was really important. Now, in terms of coordinating, right, the Fed should do what it should do for monetary policy, and the Treasury should do what it should do in terms of fiscal policy. And the level of coordination should, I think, be, sort of separate, right? They should be doing what they want to do for each of their own priorities. However, there are times when there is going to have to be that type of coordination. So, for example, right now we're doing these reserve management purchases where we're expanding our balance sheet to sort of provide a minimum level of reserves into the economy to meet reserve demand. We're buying Treasury bills. We're letting mortgages continue to mature off of our balance sheet and replace them with Treasury bills, right? Like, in theory, if we did enough, sort of conversion of our balance sheet, of our existing balance sheet into Treasury bills, we might be absorbing all of the supply, right? And then some. So this is an example of a time where there would have to be very tight coordination.
We've got an administration right now very interested in financial markets. The president often looks at where the index level is in the equity market. We've got a Treasury secretary that used to trade this stuff. Did you speak to them in your time at the Federal Reserve? Did the president ever pick up the phone and say, hey, Steve, what's happening? Tell me what you're seeing in the market and the economy?
Yeah, so I spoke to the president when I went to go resign from the Council of Economic Advisors. I went to bring my resignation letter. But, he doesn't tell me anything. He doesn't tell the whole world, right? This president is very forthright with his views, and he tells journalists all the time, including Bloomberg journalists, exactly what's on his mind about policy and where it should be. So, no, I'm not in receipt of any information that's not public.
Because we've started this conversation by talking about how you were received internally, externally. I thought unfairly at times, basically everything you said about interest rates and on the economy was always described as just doing the president's bidding at the institution, at the Federal Reserve. Did people see it that way internally? When you put your hand up and said, I want a rate cut, 25 basis points, I'm dissenting, was there a roll of the eyes, here we go, this is the president's guy doing the president's bidding?
Well, thank you for those words. I do think it's clear that I've disagreed with lots of people on policy on lots of times. There have been times when there have been signals out of the White House that they wanted policy rates lower than I had my dots, and there have been times when there's been signals out of the White House where they thought that I was too dovish, right? So, for example, the NEC director after my first vote said that he would have preferred a 25 basis point cut, right? So I clearly do my own thing and have my views, and they're all, I think, grounded in very traditional economics. And we were talking about population growth before. Like, this is not new, right? Like, 6 years ago, we all would have been talking about, is everybody becoming Japan? That would have come up several times a week, right? Like, none of this is new. None of this is heterodox economics. None of this sort of says we need to discard with the entire framework. It's all within the traditional framework. And this is part of why I think the reception internally has been generally pretty good, is because I'm engaging with folks on their ground, right? Like, I'm within the world of normal economics, and we're talking about what drives the interest rate and the neutral interest rate, and does population growth drive it, and is it inflationary or disinflationary? This is all well within sort of normal.
We're trying to figure out what kind of an institution Kevin Warsh is walking into, how he'll be treated, how difficult it will be to get people on his side as he starts to think about changing this institution, particularly when the former Fed chair will be sitting there as a governor on the Board of Governors. Can you help us understand that from a man inside the building, what that might look like in the next few months?
Yeah, so I think one thing that's important to understand is that people at the Fed are responsive to arguments. And as I said before, I've been hammering deregulation, among other things, since the day I got there. And, they start to respond, but it takes time, right? It's a bit of a slow-moving process.
Does Powell being there make it harder?
I don't know about that. Certainly Chairman Powell built a lot of the institutions and processes that exist there, and so so that dynamic may may play into it. I don't know. But that'll be an issue for Chairman Designate Warsh to deal with when he gets there.
When you heard the chairman in the news conference present to the press and to the world that he was staying on as a governor, was that the first time you heard of it, or did he tell the Board of Governors ahead of time that that was his plan?
No, he didn't. He didn't tell me ahead of time that that was his plan. But he'd always said that publicly and privately there's something he might do, and so it wasn't entirely a surprise.
What was your reaction to it?
Look, my reaction to that is that when I was the incoming chairman of the Council of Economic Advisors last year, I was very grateful to the previous chairman, Jared Bernstein, for spending time with me on the phone, being very generous with his time, several hours over days and weeks, giving me advice for how to be a good CEA chairman. And I really appreciated that. And sort of how does the place run, and what are your responsibilities, and how do you do a good job? And I thought that was really generous of him, and I was really appreciative of that. And then I went out of my way to make sure that they very quickly put his portrait on the wall of former CEA chairman in the offices in the Eisenhower building. It's to make sure that happened quickly without delay. And I was really grateful. So look, transitions are important. And I think that, it is maybe helpful to have someone there to give advice. Here's how to be an effective chairman. Here's how to lead the committee. Here's how the building works. It may be a little bit different than it was 20 years ago, right? I think that can be helpful, but I still think it's important that it be a transition, because you want to have people's loyalties undivided. You want to have there be very clearly one chairman. You want to have a place where there's no question about who's in charge, and there's no talk of rival factions and things being split. I think you want to have a sense of unanimity and clarity. And so transitions are important, and I think it can be helpful to have help in transition. But I still think it's important that it is a transition.
Stephen, it's good to see you. Thanks for being here. I just wanted to finish on this. I think a lot of people might describe your tenure at the Federal Reserve as somewhat controversial. I see it completely differently. I've seen this play out now over a number of months, and I've said this repeatedly. You've had energised debate at the FOMC that spilled out publicly in a way that we haven't seen in a long, long time, if ever, at the Federal Reserve, where people are being much more opinionated about where we are in this moment. And the one complaint, the consistent complaint I've had about the Federal Reserve is one that you've had too, which is the groupthink. And it's very, very difficult right now to describe this committee and anyone working at the Federal Reserve as part of groupthink right now, because everyone's expressing themselves in a much newer, fresher, more welcoming way.
Yeah, it seems like right now no one could accuse this committee of groupthink, given how fractured it is, and frankly, all of the commentary coming out. So over to you, Kevin Warsh, to come in and have that debate.
Best of luck. Steve, good to see you.
Thanks for
you,
having
sir.
me.
Appreciate it. Stephen Miran there, Fed Governor Stephen Miran. Let's get you an update on news worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. President Trump and Chinese Premier Xi Jinping delivering remarks at their state banquet in Beijing. Trump praising their, quote, extremely positive and productive conversations, emphasizing his long-standing personal relationship with the Chinese leader. Trump extending an invite for Xi to visit the White House in September. United Airlines expanding its service to Japan, launching non-stop flights from the U.S. to the northern Japanese city of Sapporo, as well as new non-stop flights between Chicago and Tokyo. The flights are expected to operate on Boeing's 787 Dreamliner. UK Health Secretary Wes Streeting stepping down in the last few minutes from his post, paving the way now for him to launch a bid to replace Prime Minister Keir Starmer. Starmer's former number 2, Angela Raymer, also indicating she's preparing a bid to leave the party. And that is your Bloomberg Brief. John.
Hey, Vonnie, thank you. Appreciate it. Up next, we'll get you some morning calls, plus Jonathan Krinsky of BTIG on how tech could see a major reversal. That conversation up next. Session highs, equities up 1/3% on the S&P. That is the price action. Here is your morning calls. First up, Wells Fargo raising its price target on Cisco, expecting more upside in 27. Citi raising its price target on Dell, highlighting the AI build-out as boosting server demand. And finally, Evercore raising its price target on Apple, predicting earnings and free cash flow to grow. Let's stock up in the pre-market. Let's talk about tech and tech optimism driving stocks to fresh record highs. Jonathan Krinsky of BTIG writing, we will see an equal and opposite reaction to the parabolic advance we've seen in tech over the last few weeks, which would mean another 20% lower. Jonathan joins us now for more. Jonathan, welcome to the program. 20% lower. And as you've pointed out in your research, that's all it would take just to get back to the 50-day moving average, Jonathan.
Hey, Jonathan. Yeah, I think it's just goes to show how far we've come, specifically in the tech AI semi-trade. And as you mentioned, yeah, a pullback to the 50-day is pretty normal in even strong uptrends. And that just shows, again, how extreme the move has been. So I think there is pretty significant unwind risk in this one pocket of the market.
I guess what the pushback would be, Jonathan, is that just because it looks parabolic doesn't mean it's not justified. Just because it looks like some of the previous charts doesn't mean that it's the same based on some of the profits and earnings. What would be a catalyst to this type of reversal?
Well, again, I think that's an important part of the conversation, but that's why we're saying it's, if you think about the analogies to the late 90s, the end result of that was the SOX index and the NASDAQ, it's 100, ended up down 85% from their highs. We don't think we're seeing anything like that. So I think you can still have a very strong fundamental backdrop. And as I said, pulling back to the 50-day is well within the confines of even a strong fundamental and technical uptrend. It's just gotten so extended, and there's numerous ways to measure that, but yeah, it's a bit much by our work here.
What do you see, Jonathan, in terms of people who are actually starting to hedge against the probability or the possibility of that type of downturn?
Yeah, I mean, you're starting to see a vol up, spot up dynamic within the semis. If you look at, there's a VIX for the SMH ETF, and that recently closed the highest level since March when the semis were actually moving lower. So, typically in equities, you get the underlying moving lower as vol moves higher. But in certain situations, when you get kind of these parabolic moves and people they're actually chasing for the upside more than downside, right? And so I think that's what is the concern at this point is we're seeing more, fear of missing on the upside than the downside. And you're seeing that in the options market. You're seeing that in the volumes and ETFs, whether it's the inverse ETFs or the leverage ETFs. You're seeing a lot of extreme volume at the highs, which again can indicate an inflection point.
John, another way of looking at this is that the moving averages were depressed by the shock in the Middle East, and that actually some of these names are catching up to fundamentals, not detaching from them. When you look at these moves, yes, they are parabolic, they're massive, particularly over the last month. Together with the concentration, is there a way that you look at this and say, you know what, this could resolve in a bullish fashion?
So, that's the big argument. I think the conversation that we've been talking about has in recent weeks moved from, okay, how stretched are the semis, how much further upside is there in those, to why can't the rest of the market rally despite what the semis are doing? And, there's various ways to look at this. If we just look at sector ETFs, there's only 2 sector ETFs that have made a new high in May. That's tech, obviously, and REITs. 2 sectors made a new high back in March, energy and industrials. But outside of that, most of the sectors peaked in January, February. So there's a lot of deterioration below the surface. And we just think it's going to be hard for that to support the index if tech moves lower.
Hey, John, I've enjoyed the research. Appreciate the time. Jonathan Krinsky there of BTIG. Something to think about. Up next, some breaking data, jobless claims, retail sales, reaction from Neela Richardson. Equity futures session highs up by 0.4%. The opening bow 60 minutes away. The economic data 20 seconds away. Up a third of 1% on the NASDAQ. A really, really good IPO coming from Cerebras based on the pricing anyway, and some 99 type 5s when you look at the earnings coming from Cisco. Just fantastic earnings from them, supporting this equity market. In the bond market, yields are high. We've had a hot CPI, a hot PPI, yields at 444 on 10s. With that economic data, let's cross over to Mike McKee for more. Hey, Mike.
Good morning, John. Well, retail sales coming in at about what was forecast. The advanced headline number up 0.5%. We're still waiting for the other things to drop, so I'll point out that initial jobless claims basically at 211. That's up from 199, a revised figure from last week. Continuing claims 1,782,000. That's up from 1,758,000. So no real change going on in the labor market there. And as we wait for the retail sales figures to slowly come out, import prices up 1.9%, a big jump there from 0.9 last month, but ex-petroleum up only 0.7. It's still a strong number, may affect the PCE inflation index, but a lot of that is gas. Okay, we've got some more numbers now for the retail sales. Ex-auto up 0.7%, and ex-auto and gas up 0.5%. The same story for retail sales control. That's the one we really care about. It was up 0.8, a revised 0.8, which is a tenth stronger than last month, but it drops in the month of April to 0.5. So I'll check on the basic components of all this and be back with you in a minute.
Mike, thank you, sir. Looking forward to your coverage of this story. Our coverage from a market perspective looks like this. Equity futures still doing OK on the S&P 500. Not a big move here on the S&P, the Nasdaq and the Russell. Futures still positive going into the cash open, up 1/3% on the S&P. Turn to the bond market. Yield's not moving much on the 10-year or the 30-year. The 2-year down 2 basis points, the 10-year down by 2 basis points. That's where we were heading into this. The 30-year holding on to 5%. When you look at these figures, it's not really going to move the story on too much. These numbers for April for retail sales, they're good, they're decent. Slightly better than expected by some measures. Put it together with jobless claims, that's fine, that's OK. 211 on jobless claims. There's still a decent story to tell about the US economy.
This isn't the economy falling off a cliff. It's not necessarily people going out and spending everything in the bank. At the same time, the upside surprise, the consistent upside surprises gives you a sense of just how OK people are doing. The idea that not only is it an upside surprise for the control group at 0.5% versus 0.4%, but the previous month was revised up to 0.8% from 0.7%. The upward revisions gives you a sense the trajectory is higher, not lower. People are absorbing the costs, even if it doesn't make them feel good.
It's not consistent with record low consumer confidence coming out of you, Mitch, is it? Numbers like that.
Well, people are worried about gas. There also is a difference between the average and the median, right? I mean, this is something else that we keep talking about because there is a lower income cohort that is seeing any kind of gain from either from wage increases or the one big beautiful bill completely eroded by higher gasoline prices. That probably is not captured in this rate in terms of retail sales. It's people who do have discretionary income that are going out and spending on clothes and Shake Shack burgers.
Mike McKee's still standing by. He's not buying Shake Shack burgers. Mike, they've got way too expensive. We can talk about that another time. Mike, you've had a second look at the numbers. What do you see?
Well, it is, as we anticipated, a gasoline story. Sales at gas stations up 2.8%. Remember, retail sales calculated on a dollar volume basis. If you take gasoline out of the headline number, the headline would be a 0.3 gain instead of a 0.5 gain. We do see some declines here. Auto sales and parts down 0.4%. Furniture and home furnishing stores down 2%. Clothing stores down 1.5%. And department stores down 3.2%. Now, much of that department store money probably went into the internet shopping craze. Non-store retailers up by 1.1%. And perhaps one of the things that we really want to look at here is that food services and drinking places, which we always note is a very discretionary item, were up a strong 0.6%. So there are still people out there spending. Some of the categories have changed, but for example, food stores still up 0.8%, groceries up 0.7%. Some of that is going to be inflation, but people have not completely backed off yet, even though some categories are down.
Mike McKee, thank you, sir. Breaking down the economic data. If you're just joining us, welcome to the programme. Retail sales coming in slightly harder than expected for the month of April. The control group came in at 0.5%. The estimate in our survey was 0.4%. As for jobless claims, slightly higher than expected at 211, but take the 4-week average. The 4-week moving average on claims is around 204. 204 is incredibly low. That is good news for this labour market. That data is OK.
Yeah, we aren't seeing anything in terms of a warning sign from that. I will just say my big takeaway from this, electronics are up 1.4% for the April read, which gives me a sense that it is no longer discretionary to have an iPhone or to have some sort of smartphone. Seriously, I mean, at what point are people saying that is sort of a baseline purchase along with going out to eat at different restaurants with my friends?
It's a staple. I agree with you.
I think that that's the shift, right? Why buy another, dresser if you can go out and buy an iPhone?
It's a very expensive staple.
I'm serious. I actually think that that's part of it.
Nita Richardson of ADP joins us now for more. Nita, good morning.
Good morning.
We'll avoid that conversation. We'll talk about the data we just got, retail sales and jobless claims. Is this data doing all right? Is this economy OK?
The headline numbers are all OK. You look at those retail sales, impervious in some ways to recent shocks, impervious to downbeat sentiment. You have a jobs market that's still functional, still producing jobs, and you have wage growth that's still holding its own. The interesting part is underneath the surface always. So going a level deeper, just how much did energy prices impact retail sales? That iPhone is now a durable good, not something we switch out every 2 years. So there is some change in consumer spending. And then you got some data from the BLS saying that real wages actually edged down. They declined. And so you put all that together, yeah, it's a pretty good economy, but that doesn't mean there's not tensions underneath.
You nailed the one tension, it's real wages, the squeeze. You worried about that?
Yeah, and here's why I'm worried. So when we look at our data at ADP and we're able to match individuals over time, we're seeing a couple things. The first thing we're seeing is very robust wage growth. Even when we put divided into the bottom quartile and the top quartile of income earners, wage growth is robust. But here's the rub. There is this widening inequality gap. We're tracking it in real time. Last year, the wealthiest 25% made about 500 times what the lowest bottom 25%. I know, you raise your eye. It's
crazy.
A lot. This year, it's more like 640% more. So we're seeing this widening gap. And that's an issue because the wealthier, the higher income you are, you start saving, you start investing. Good for you. Not so great for the economy. Consumers at that bottom end, they spend more. And when you don't have that savings lever and prices go up, you stop consuming as much. And that is the concern when it comes to wages.
This has been the conundrum when we talk about this all the time. It really is an increasing issue, and you're seeing it politically, but you're not seeing it in the overall averages from economic data. At what point does it become more of a concern on the averages, not just a political problem, but a market problem?
Yeah, wage inequality is really it's a long-term drag on economic potential for the reasons. We are not a savings and investment economy. We are a consumption-driven economy. And if you have a significant portion of the new jobs, remember, a lot of jobs that are coming on are those low-paid, hourly working jobs. So our labor market is being fueled by low-paid jobs right now. And then you have those very same people who traditionally spend more out of their income not consuming as much because of higher energy prices. So if I could bottle this up in like a tagline, monetary policy is really concerned with core. Consumers are really concerned with headline. And this wage inequality hits right at that headline difference in higher income and lower income when it comes to spending.
What would help the lower income consumer more, a rate hike or a rate cut?
That's a great question. If you're in the bottom quartile, unfortunately, buying a house is probably not on your horizon. It's just too expensive now. So borrowing money, it would help with credit card fees. If you're putting more and more of your consumption in debt, or that would be helpful. But that's not the way to increase growth. The way to increase wages is through productivity enhancement. So if you can get an economy that invests in a way that creates more jobs and increases wages and standards of living, that's wonderful. But will, a couple basis points downward or a couple rate cuts actually lead to those changes? It would be hard to see that in real time.
Are we seeing the standard of living climb for everyone? This whole conversation, and forgive me for sort of digressing a bit, reminds me of an address from Margaret Thatcher to Parliament. And she went at the left wing of Parliament at the time, and she talked about the gap between the rich and the poor. And her accusation to people on the left in Parliament at the time was that the only thing you care about is making the gap smaller. And you don't care if the poor get poorer. Do you remember that line from Margaret Thatcher? Now, for me, the gap alone is not concerning so long as everyone's living standards are improving. So if you see the upper income cohorts get a lot richer than lower income, but living standards for everyone climbs, you've got an argument to make that maybe we're moving in the right direction. Is that happening now? Has that been happening?
Actually, you uncovered a tension that I have, because you are seeing really robust wage growth even at the bottom quartile. So it's not that lower income people are not seeing their wages increase faster than higher income people. It's quite the opposite. The problem is it's still not enough, and you still continue to see this gap widening. If the gap stayed the same or narrowed, there's an argument right in line with Thatcher. But the fact that it's widening is problematic in terms of economic growth long term.
Nina Smart, it's good to see you, as always. Nina Richardson there of ADP. The problem's the price of everything, and the price of everything is too expensive for many people.
And right now, the wage growth that you're seeing at the lower end isn't compensating for the higher gasoline costs. In fact, it's eating up any kind of wage growth. So this is a reason why, the question of what would help them more, a rate cut or a rate hike. What's the bigger tension? Growth not being fast enough or inflation being too high and crimping their standard of living? Unclear right now. And that ultimately is a tension that Kevin Warsh is going to have to handle.
Equity futures positive in the equity market going into the opening bell. Let's get you an update on stories worldwide with your Bloomberg brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. So recapping the data we just got then, jobless claims coming in at 211,000 last week. That's lower than the estimates for 205,000 claims. Retail sales for the month of April rose 0.5%. That was in line with expectations, suggesting high gasoline prices prompted some consumers to temper spending. Cisco shares rising in the pre-market. The company reporting fourth quarter guidance that topped estimates by nearly $1 billion. Cisco also announcing plans to cut almost 4,000 jobs as part of a restructuring to focus on AI. GameStop CEO Ryan Cohen is planning to take his takeover offer directly to eBay's shareholders. This, according to reporting from the Financial Times. The report comes after his request to meet eBay's board of directors was rejected. And that is your Bloomberg Brief. John.
Vonnie, thank you. Appreciate the update. Up next on the programme, we'll catch up with Julie Biel of Kane Anderson Rudnick on how economic uncertainty could end up boosting markets. Plus, AMH is in Beijing for the latest on that summit between the two leaders of the two largest economies on the planet, President Xi Jinping and President Donald Trump. Equity futures positive here by 1/3% on the S&P from New York. This is Bloomberg Surveillance.
Transitions are important, and I think that, it is maybe helpful to have someone there to give advice. Here's how to be an effective chairman. Here's how to lead the committee. I still think it's important that it be a transition because you want to have people's loyalties undivided. You want to have there be very clearly one chairman. You want to have a place where there's no question about who's in charge.
That was Federal Reserve Governor Stephen Miran in his last broadcast interview as a Federal Reserve Governor on the situation with Chairman Powell staying on as a governor alongside incoming Fed Chair Kevin Warsh. Kevin Warsh, of course, just confirmed his first day at the Federal Reserve, likely in the next 24 hours. Equity futures right now, the S&P 500 firmer by 1/3%. On the Nasdaq, up by 1/10. We're adding to all-time highs. There are some really bullish tech stories out there this morning. Let's get you a few of them with your morning movers. Yahara has more. Hey, Yahara.
Hi, John. We start with Cisco. Shares are surging on nearly 15% in the pre-market. With this jump, it will be Cisco's biggest post-earnings jump since 2011. The company delivering a beat and a raise and saying that it is cutting thousands of jobs in order to shift resources to AI. And in another bullish forecast, it is raising its outlook for AI orders from hyperscalers from $5 billion to $9 billion in the next fiscal quarter, in the next fiscal year. Meanwhile, we saw clothing sales fall 1.5% in the latest retail reports, but Canada Goose is bucking that trend. Shares are up 3.8% after the maker of those pricey parkas delivered a big revenue beat, topping even the most bullish forecast on the street. And we end on shares of Klarna. They are soaring 12.4% in the pre-market after the buy now, pay later firm swung to a surprise profit last quarter, a major turnaround from the nearly $100 million loss it posted a year ago. The results pointing to a consumer that's still spending, but maybe leaning more on those installment payments in order to do so. John?
Yahara, thank you. Appreciate the update. Some of the challenges in retail right now. Have you seen some of these names? Nike's down by 33% year to date. Lulu's down by more than 40% year to date. You want signs of a challenge right now in retail. Brutal stuff. Brutal for those names.
Yeah, it seems like right now it's a sort of shakedown or shakeout, I should say, of the winners and the losers, right? Because you've seen some do very well. You've seen, for example, Walmart or Amazon, which have other types of venues. But Nike, get back to running. Lululemon with a new boss and a question of how you're going to resurrect a brand that's come under competition from a looser trend, not necessarily the skin tight pants, and also a lot of competition. I mean, these are some specific challenges in addition to the broader, more stressed consumer.
Be aggressive, don't apologize. That seems to be where success is found in retail right now. Think an American Eagle, aggressive, didn't apologize. Great success off the back of that. Lulu, too apologetic, too nervous about doing certain things. Nike, the same thing.
Well, American Eagle and Gap have both been very sort of edgy and embracing that in different kinds of ways. I think that Lulu has been beset by a host of different issues, see-through issues, as well as, just trend issues. And Nike, of course, a real question about its strategy, sell to consumers, sell through some of these other brands. So there clearly are questions. I do think, though, you're seeing a bifurcation between the haves and the have-nots within retail as well.
Going to the World Cup, notably not seeing anything from Nike at all. Saw a great Adidas commercial with Timothy Chalamet. Fantastic commercial.
I did see
nothing
it
from Nike. See if the next few weeks changes things.
Yeah, maybe they can come up with a rival or bring Timothy Chalamet on and have sort of the next segment of that soap opera.
That would be very cool. Let's see if they make that happen. I doubt they will. As we count down to the opening bell, Julie Biel, Kate Anderson-Rudnick writing, investors need to be able to compartmentalise some of the news, some of the gloom from the main event, which is earnings growth. Julie joins us now for more. Julie, welcome. Earnings growth has been just so powerful. Do you just want to stick with it, stick with this bull market?
Yeah, I mean, I think you can stick with the themes where you have a lot of confidence that there's long-term durability to the growth. It's hard to get super enthusiastic about some of these semiconductor names at these valuations, or some of these industrial companies, especially in small cap, that have some exposure to what we see in the tech build-out and the data center build-out, but that generally are kind of commodity businesses. Those are the ones that I think we want to skip out on. But broadly speaking, this level of earnings growth, up and down market cap across industries, it's really broad, it's really robust, and it's thanks to no one in the government, let's be clear.
Within tech, and I'm not going to take the bait on that one, within tech, are you starting to see a rotation from just the chip players to others? We've been talking about just how much Oracle, Meta, Microsoft have lagged. What needs to happen there for those names to work?
I think that people need to feel a little bit more confident that there is going to be a return on investment of all of this CapEx. I think they're going to stay in the doghouse. And part of what's really difficult is you have to separate some of the names where they are generating a real return and they've expanded and broadened their business. That's Google. But Meta, I think people are not satisfied by the idea that they eat their own cooking, that the AI is what makes their ad business stronger. I think that's not good enough right now for investors. People want to feel like we're building real logical businesses on top of this, because right now, at the level of spend that we're at, Anthropic isn't making any money. They're bleeding money. So is OpenAI. So we know that the way these large language models are structured, they're not profitable right now. And I think people need to feel confident that they're going to be at some point.
Do you think that any potential IPOs later this year could pose some sort of headwind to the rally in other tech stocks that we've seen so far?
Yeah, absolutely. I think that, for the moment, a lot of the excitement that we've seen in the private markets for OpenAI and Anthropic is really a function of the dominance that they have as these, preeminent models and the excitement of the growth that they're able to deliver. The problem is that when those S1s hit and they come to market, people like me, grubby little profit-seeking people like me, are going to be upset at the level of spend that they have without any kind of real return. So I think that's a real challenge for these businesses. And the concern that I have is I really hope that they don't come to market with these kind of made-up terms for, you remember when WeWork was community-based or community-adjusted EBITDA? We can't have that. It has to really be kind of clean financials, that people have a clear path that we're going to be able to raise rates on these tokens and earn a real return. It can't just be endless negative earnings for the foreseeable future.
I wouldn't describe you as grubby, Julie. I'd never do that. Julie Biel of Kate Anderson-Rudnick. Would you describe Julie as grubby?
Oh, of course not.
Absolutely
not. I think that was wonderfully said.
Come on.
Wonderfully put, perfectly put together.
Programming note a little bit later on this evening. Look out for this. Ambassador Greer, Jameson Greer of USTR, on the situation over in Beijing, China. Conducting that interview, none other than Annmarie Hordern on the ground in Beijing. AMH, welcome back to the programme. What are you looking forward to a little bit later this evening?
I think we want to get some clarity from Ambassador Greer on exactly what was discussed between President Trump and Xi Jinping, especially when it comes to his portfolio, when it comes to trade. Already, in maybe a sign of goodwill, we've already seen Beijing have a number of licenses now lifted and granted to have more beef imported into China. That is definitely a sign of goodwill. But what else when it comes to U.S. energy and potentially that Boeing jet order? What else was discussed in terms of these purchasing agreements? And what's the future more broadly of this relationship? There's been a lot of talk leading up to the summit about a board of trade potentially lessening the tariffs on both sides when it comes to a lot of consumer goods worth $30 billion. So these are a lot of questions for him. And then, of course, I think what on top of everyone's mind is what happened in terms of the readouts. They are so different when you look at what the Chinese express as their main concerns when it's Taiwan. While the meeting was still happening, the readout came from the China side, how they said if this issue is mishandled, it could mean a dangerous situation for the bilateral relationship between Washington and Beijing, yet Taiwan wasn't even a mere mention in terms of the White House readout.
Annmarie, appreciate your time and looking forward to your coverage a little bit later. Get some rest. Annmarie Hordern over in Beijing, China, on the summit between the two leaders of the world's two largest economies, President Trump and President Xi. Whenever we get these readouts, there's always differences. That's not new. What's interesting about this to me, and Annmarie's talked about it throughout this morning, was just the timing of the Chinese release, that they just got ahead of things. Whilst the summit was still ongoing and made Taiwan a big feature of the media coverage around this event.
Yeah, and they've talked before about Taiwan being a priority for them. Nonetheless, they came out with notably strong language saying that this is the red line. I just want to make a programming note. Yesterday, Eddie Fishman came out with the 5 Bs. I got this right this time. Beef, beans, Boeing, Blackwell, and Board of Trade, because I'm doing better, John. And today, Erica Najarian came out with the I's. Yes, 100%. Iran and inflation. So tomorrow, I'm excited. You know, it's sort of the Sesame Streetification of surveillance. We can sort of have another letter tomorrow that can try forward the narrative.
I didn't say it in a serious way, did I?
No, absolutely
Surely not. Come on.
No, not at all. He was like,
feel
hopefully,
so bad now.
No, please don't. No, that was hilarious. It was very well put.
Stage is set for another rally. How are things looking? Only up by about 0.25%, but plenty of bullish news around tech once again.
The idea that Cerebras could come out with such strong pricing, the idea that we saw such incredible results from Cisco, regardless of some of the naysayers, the profits continue to be there. And as a result, people are looking at this as a haven trade amid myriad concerns, whether it's inflation in Iran or whether it's beef, beans, and Boeing.
Nice. And Blackwell.
And Blackwell.
And Board of. There we go. All right. Do better. Coming up tomorrow, Matt Miskin of John Hancock, Savannah Rajappa of SocGen, Erin McLaughlin of the Conference Board, and Scott Cronin at Citi from New York City this morning. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.